Good morning, everyone. It's almost 8:30 a.m. here in New York City. I'm Brad Smith alongside Shauna Smith. This is Yahoo Finance. We've got some special coverage for you on this here Jobs Day. To all who celebrate, everybody's celebrating today. Why not? We're going to be waiting for these non-farm payrolls expected to show a gain for the month of May of 180,000. That's the headline expectation. Unemployment rate expected to be at 3.9%. And year-over-year wage growth, we're expecting that to come in at 3.9% as well, Shauna.
Yeah, and I think the wages, that portion that you just ended on, 3.9%, that's really going to be one of the key critical points within this report when we're talking about the Fed's assessment potentially of the print that we are about to get here in just about a minute from now. If that comes in hotter than expected, even at that 3.9%, clearly well above where it needs to be in order for the Fed to get down to that 2% inflation goal here. So that needs to be more around consensus, around 3% there to better line up. So that will be a focal point within this report. And then I also think just taking a step back when we talk about some of the trends that we are starting to see, whether or not that continuation of cooling or that narrative stays intact. Of course, any sort of print here that could really change that narrative. We will likely see that reflected very quickly here in the markets. But again, a lot riding on this print and, of course, coming ahead of the Fed's meeting next week.
Yeah, and we've got a bit of a FOMC preview for June as we're kind of looking at how all of this relates to it, especially when you think about the data that we got last week paired with the data this week on the employment front here in a myriad of forms, whether you look at and want to favor JOLTS or want to look at ADP payrolls, all of these things considered, it's going to come down to how the FOMC is looking at this. And right now, B of A is saying that they're staying on hold and projecting 2 cuts at the June FOMC meeting. They see the Fed revising its outlook in favor of slower growth and firmer inflation here. And so that they expect should project 2 rate cuts this year and a cutting cycle that begins in September.
Wow, Brad, taking a look at this number here, a massive beat for jobs, 272,000. The estimate was for 180,000. When you take a look at the unemployment rate, ticking higher to 4%, so that was 0.1% higher than what we saw the prior reading, and 0.1% higher than what the street had been forecasting. Average hourly earnings on a month-over-month basis ticking higher by 0.4%. When you take a look at that year-over-year comparison, rising 4.1%, hotter than what the street had been anticipating. Labor force participation rate coming in at 62.5%, which was just below what the street's expectation was, and also comparing it to that prior reading of 62.7%. So again, a much hotter than expected print here. When you take a look at some of the revisions that we are getting, revisions here to the downside for the prior month, 175 was revised lower to 165,000, so revised lower by just about 10,000 here. But again, that headline number, 272,000, much hotter than the street's expectation of 180.
Yeah, I'm taking a look at some of the sectors here. Employment continuing to trend up in several industries led by healthcare, government, leisure and hospitality, and then professional, scientific, and technical services as well here. And then just taking kind of a bit of a deeper dive into what you mentioned here, labor force participation rate, 62.5% here. That was essentially little change there in May. And then one of the other huge things that we got to point out to here as I was continuing to look at some of those sectors, healthcare adding 68,000 jobs during the month of May. We'll have more of a breakdown on the sectors in just a little bit.
Yeah, and this could potentially be concerning for the Fed on a number of fronts, but I think one of the most important reasons here, when you take a look at that headline number, clearly much stronger than expected. When you take a look at the fact that the unemployment rate ticking up, as well as that labor force participation rate falling, clearly that could be a bit worrisome here for the Fed ahead of the meeting. And next week, when you take a look at the futures reaction, we are certainly seeing declines in reaction to this news. Let's get over to Jared Blickery for a closer look at the reaction that we're seeing in the markets. Jared.
It's risk off here, and you could say this is a mixed report, but we've got something for the bulls and the bears, but it looks like the bears are winning out now. So this is our world map, and you can see behind me as I pull up the Dow futures, we were in the green just slightly before the report, and then we sold off pretty hard to the downside. Still, we're only talking about 1/3 of 1%, so not a huge move, but where we're seeing some of the most movement is actually in the Russell 2000 futures, and those are now down about 1%. I'll also show you the NASDAQ, and we can get the NASDAQ, interestingly, is not down as much as the others, and also it was more in the green than when we started, and we can also take a look at the S&P 500. So looks pretty similar to some of the other markets that we've been looking at there. I want to take a look at the bond market now, and the initial reaction was to the downside in the 2-year Treasury note futures. That means that rates are going up. They're pricing in a maybe slightly more hawkish Fed, so we'll have to see how that plays out. And I'll also add that a lot of times you get a fake out move. Sometimes the first move is just kind of a fake out, and then you actually switch directions and carry higher or lower in the opposite direction throughout the day. So I do want to throw that out there. A lot of day traders love this report because of this types of price action. Here's gold futures. Now, gold futures were already down, and you can see they took a little bit of a dip here, but not too much. Still hovering around $2,300 per ounce. And let's take a look at copper as well. It looks like just a very, very small downtick in copper. And one of the markets I like to look at here is also Bitcoin. Not seeing much of a reaction, if anything, in Bitcoin, so we'll continue to monitor the crypto aspect to the jobs report as the day develops here.
All right, Jared, thanks so much. We're going to take a deeper dive here for more on the May jobs data. We're joined by Lauren Goodwin, who is the New York Life Investments economist and chief market strategist, and Robert Socken, who is the Citi senior global economist, both joining us now here in studio. Great to see you, and thanks so much for joining on what is a better than expected print, far exceeding what the expectation was coming into this. Lauren, you said in your notes, bad news is not bad news yet. Well, this is good news. And for the markets, it's turning out to be bad news, at least in the pre-market trade.
Yeah, that's right. I think the market, as well as the Fed, were hoping to see a little bit of evidence of softening in the labor market because the other side of the Fed's mandate, inflation, just doesn't stack up against cuts at this stage in this cycle. And to see more confidence that inflation could move lower over time, you'd really like to see the wage numbers look a little lower than we've seen them today. And so this is good news for the economy. Markets have been very focused on growth. So I think that given the earnings backdrop in the economy, we can continue to see the markets take this in stride, but I expect that it will have a major impact on the Fed's decision next week, likely to price in fewer interest rate cuts for the remainder of this year.
How do you think this shapes the Fed's narrative?
It's a great question because I think what we're living through is the challenges of judging the economy in real time with a very mixed set of signals from these data. So much stronger than expected job growth. Typically, I would say payrolls is the best indicator of the underlying health of the labor market, so that's really good news. You're getting some more soft prints within the household survey, so the unemployment rate's been ticking up, but maybe that survey isn't capturing the large migration flows that we're seeing in the economy as well as the payroll survey is. So maybe there's more noise than signal there. But at the same time, a third factor, as Lauren pointed out, that very hot wage growth. And where you're still seeing inflationary pressure is in the services sectors that are more wage intensive. So it's a mixed bag for the Fed. They'll be happy the economy is holding up well, but probably we're looking for some more slowing and some more cooling, especially on the labor wage side.
So then, Robert, what do you think that tells us about the Fed's timeline for cutting? Because Citi, for a long while, has held that view that the Fed would likely cut in July. Is that still on the table?
Yeah, our U.S. team still has that July cut, kind of based on two factors. One, a softening in the labor market, enough of a softening really that the Fed is getting worried about recession risk, and enough cooling in the inflation numbers to justify cuts and then putting more weight on the employment side of the mandate. I think here with very strong payrolls and hot wage growth, it's going to really challenge that call of July. But that's what it's based on. It's not dead in the water yet, but that's a tough print for that call.
Lauren, can the markets continue to see all-time highs if we don't see the data line up in terms of what would actually what would warrant a cut for the Fed?
I think it's challenging on the tactical front. So until we have another round of data, we get inflation data on Wednesday, another employment report in another month. But with the way that the data sits today, it's challenging to see markets climb infinitely higher. Earnings season is behind us. The markets have seen better than expected results on that front. And as Rob points out, this is frankly a better than expected economic front still. But it's one in which I think the conversation in the market is going to begin to turn towards how much longer, if the Fed holds interest rates where they are, can the underlying economy avoid broader cracks? We're starting to see cracks in lower income consumers, in elements of the credit markets, especially in floating rate credit, that have been absorbed relatively well so far. But the longer you stay in an environment like this, the higher the risk becomes that a future credit cycle would be more pronounced.
What do you think, Robert? Do you agree, just in terms of some of the cracks that are starting to form?
Absolutely. I completely agree with Lauren. We've been highlighting the same type of cracks, lower income consumers, and you're seeing that manifested in higher subprime delinquencies, drained excess COVID savings. That most of those savings still seem to be concentrated now at the higher income end of the spectrum, ongoing tightening in credit conditions and weak credit demand. So all of these factors are in play. Right now, though, the economy has held up surprisingly well given those strains. So I would still note them as yellow warning signs rather than red, but they've been yellow warning signs for over a year, and the longer we stay at these restrictive levels, the higher probability those cracks grow into something more insidious.
Does the Fed do they risk overrunning higher for longer here?
I think that's a real risk, and they're really walking a very delicate tightrope here. They feel that they're restrictive. They feel they haven't seen enough progress on inflation. But the longer that they hold things here, the more those cracks that we talked about develop. And that's really why if we were seeing a deeper weakening in the labor market, as our U.S. team thought for this report and thinks will happen going forward, that they'll be quick to react to that because they are worried, I think, about how long they can stay here. So yeah, it really, the longer we stay at this place, the more challenging that trade-off becomes for the Fed.
And Lauren, to put your strategist hat on again, I'm curious just in terms of what this means for investors, for our viewers out there, in terms of some of the pressure that we could see on the broader markets here. Clearly, we're seeing that reaction play out in futures activity right now. But that longer term impact, how do you see that playing out? And what are some of the things that investors need to be, I guess, looking for over the next coming weeks?
I'm so glad you asked, because I think that the fact that we're likely to see some market weakness today really isn't a decision-making factor for most investors. And the fact of the matter is that when the economy starts to slow, that can still be a very constructive time for risk assets because of the dynamic where if you see interest rates coming down later in the year, that you have some expected boon from that activity. What we're doing from an investment perspective is acknowledging that risk assets probably do have more room to run in this late stage of the cycle. Until jobless claims really start picking up, we don't tend to see the market react in a recessionary manner, and we're not seeing recessionary data today. In the environment, though, that we have where valuations are high, we think that this sort of late stage cycle is a really good opportunity to rebalance. So take some gains in large cap US growth equity, deploy them in international equity, maybe even deploy them in fixed income, which is one of our favorite plays, because you can take some equity-like risk in asset classes like high yield while gathering a high coupon with rates at the levels that they are.
All right, Lauren Goodwin, New York Life Investments economist and chief market strategist, along with Robert Sockin, a Citi senior global economist. Thank you both for joining us here today.
Thank you.
Thank you.
All right, let's do a quick recap of the jobs number. Again, 272,000 jobs were added to the U.S. economy last month. Unemployment rising by 0.1% to 4%. Average hourly earnings on a year-over-year basis coming in at 4.1%. That was hotter than what the street was looking for. When you take a look at the market's reaction to this hotter than expected print, to no surprise, you're looking at some pressure here across the board for futures. You can see that all three of the major averages on track to open the trading day in the red. On the flip side, you're seeing this surge, this bump in yields, especially some of the movement that we're seeing in the 2-year yield here early today. All right, keep right here on Yahoo Finance. Coming up next hour, we will speak with acting U.S. Labor Secretary Julie Su to get her take on the jobs report. We'll be right back.
U.S. added 272,000 jobs in May, far more than the 180,000 that was expected. The sectors with the most job gains included healthcare, leisure, and hospitality. And we've got team coverage to break down the hottest sectors. Alexandra Canal, Madison Mills, and Anjali Kamlani tracking the gains. Ali, let's start with you and the jump that we're seeing in retail jobs.
Yeah, Brad, the BLS calling out retail trade in the report. We did see trends continue to edge higher with 13,000 jobs added in the month of May. Now, that's roughly in line with the average monthly gain over the prior 12 months when we saw the retail sector add 8,000 jobs. Now, within retail, building, material, and garden equipment, along with supply dealers, added 12,000 jobs in May, while job losses occurred in department stores, about 5,000 losses there. And then furniture and home furnishing retailers, that also saw a loss of jobs by about 4,000 on a year-over-year basis. The unemployment rate for wholesale and retail trade did tick down to 3.7% on a yearly basis. That's down from the 4.4% seen in May 2023. Of course, it's been a bit of a mixed bag for retail so far this year. We've seen increased layoffs across the sector, while the U.S. consumer has showed signs of slowing. We got the retail sales report for the month of April, flat in the month. So the consumer not unstoppable as we once thought. Later this month, we will see the pulse of consumers when it comes to retail for May. But again, jobs still continued to be added, 13,000 jobs for retail trade in May.
All right, Ali, thanks. Let's get over to Anjali. Anjali, taking a look at the healthcare industry. What are you seeing there?
Huge gainer there, of course, with the average monthly gain of 64,000 jobs over the last 12 months. We've also seen that the total number, 68,000 in the last month, 50 compared to 56,000 in April. So a huge gain there. Most of the gain ambulatory, 43,000, which is the biggest number. We're going to focus on that in a second. And then hospital adding 15,000 and nursing homes adding just 11,000. Interesting to see that number there because we know about the demand for the aging population. We've seen those demand for the healthcare services post-pandemic, and we know that there's a majority now insured population, whether through Medicare, Medicaid, or commercial. And so we've seen that push to demand in those non-hospital settings, and that is coinciding with the increase in telehealth, increase in retail, as well as subscription-type models like Amazon's One Medical. But we've also seen weakness on that retail side. Companies like Walmart, Walgreens, and Dollar General ending their healthcare efforts in the past year. So that is going to create a bit of a shuffle in where these professionals are going. The numbers also hide the fact that the sector continues to see high attrition from burnout, healthcare professionals seeking more work-life balance in alternate care settings. But that doesn't hide the fact that we do see this ongoing push into the alternate care and to that outpatient setting. That's why those ambulatory numbers continue to be so high. And so we have to keep an eye on how all this pans out for the upcoming month. And then we know that there's also seasonality during the winter months, increase of the respiratory virus season. So all of that playing a role in how we're seeing this pan out.
All right, hugely important. Thanks so much, Anjali. Maddie, leisure and hospitality was unchanged. You're tracking that in the month, but it had a huge gain in May, right?
Yeah, Brad, so this is going to be a critical thing to watch for the Federal Reserve, right? Because we know the demand for services has been a key factor in inflation. So this is a really big move to the upside here. We had 42,000 jobs added in the leisure and hospitality space for the month of May. Now, this could be seasonality, right? Think about as you head into the summer, obviously there's going to be a lot of hiring in the hospitality and leisure sectors. But whether or not this is a sign of too much growth that's going to fuel inflation could be an issue for the Fed. Back to you, Shauna and Brad.
All right, Maddie, Anj, and Ali, thanks so much for breaking that down, some of the action that we're seeing across the board when it comes to those gains in those various sectors. All right, let's talk about the impact that immigration is having on the U.S. economy and the jobs market. The U.S. adding 272,000 jobs in the month of May. Those recent job gains coinciding with a huge pickup that we're seeing in immigration. Now, to put this in perspective, immigrants now make up over 18% of the U.S. workforce. Now, this comes as there has been this battle playing out inside D.C. about how exactly to address immigration issues. In April, the number of encounters at the southern border remained near its highs of 180,000. So let's talk about what this means for the U.S. labor market. For that, we want to bring in Wendy Edelberg, the Hamilton Project Director and Brookings Institution Senior Fellow in Economic Studies. Wendy, it's great to have you here. So first, let's just take a step back. And I think if you could lay out for us just the impact that immigrants are having on the U.S. workforce right now, and ultimately the impact that that is having on the economy.
Thanks for having me. So to understand today's labor market, you have to understand what's happening with immigration. The surge in immigration has radically changed the labor market numbers that we're seeing. So think about it this way. Before the pandemic, and in fact, really before the Congressional Budget Office did the hard work to figure out really what was happening with immigration in the past couple of years, we thought that immigration would be running in 2022, 2023, 2024, about 1 million people. So that is to say, CBO thought that immigration in 22 and 23 would be about 2 million in total. Instead, they now estimate it was about 5.5 million people in total. That's a very large difference. And what that means is that the labor supply has been growing much faster than we anticipated. And, if you're an economist who's been looking at the labor market all this time, you probably thought in the back of your mind that a stable payroll employment number that didn't have inflationary pressure in it might be something like 75,000 a month. Maybe if you were super optimistic, you thought it was like 120,000 a month. Now, given this surge in immigration, a stable employment number is more like 200,000 a month. So basically take whatever you thought you understood about the labor market before and double it. And what that means is that today's number is still super strong, but it's not like wildly off the charts, unprecedentedly strong. It makes a lot more sense once you understand what's been happening to labor supply.
And Wendy, we got an executive order this week on immigration. It's likely that there perhaps isn't much effect that's going to have. I mean, many who were discussing it and really looking through it were saying it might be the essence of a nothing burger because of the fact that you still have so much that still needs to be done on a policy perspective here that's really going to require both sides of the aisle coming together. What is the net effect as it relates to employment, though?
So it depends what your frame of reference is. So first, let's step back a second and say that this executive order will likely be challenged in the courts. So that would certainly make it a nothing burger if the courts strike it down. If it is implemented exactly as written, my sense is that it would reduce the number of asylum seekers coming into the country who are allowed to work here legally after a certain number of months. It would reduce that by 1/3. So that's not nothing, but that's not a completely different labor market. But where I definitely want to temper expectations, and where you're right to be cautious about thinking about the fact, how much this executive order is going to affect the economy, where I really want to temper expectations is what it will do to the economy in the very near term. What we're going to be seeing in the labor market over the next month, over the next 4 or 5 months is very much determined by what's been happening to immigration since 2022. There's a lot of labor supply growth still in train. So even if the executive order is implemented exactly as written over the next handful of months, we're not going to see a big effect on the aggregate U.S. economy.
When you talk about the responsibility here of immigrants enabling the U.S. to avoid a recession, is that in fact true, just given the fact of how strong the U.S. labor market has remained, the fact that the labor market remains very tight, the fact that, yes, wages have increased, but maybe not at the pace that they maybe would have if you didn't have the population, the immigration population as we do today? I guess put that in context for us.
Yeah, there are two interesting points of comparison here. So one is taking the labor market that we saw in 22, 23, the first half of 2024, and trying to understand it with and without immigration. If you try to understand it without understanding the surge in immigration, you're going to look at that labor market and say it is wildly hot, and monetary policy has a lot more to do to get the labor market on stable footing to make sure inflation comes back down to its target. That's one really important point of comparison. The other point of comparison that I think you more have in mind is what the economy would have looked like without an immigration surge. That's an interesting question. It's less important for monetary policymakers right now, because of course we did have a surge in immigration, but nonetheless, it's interesting to talk about. And in that regard, The surge in immigration in 22, 23, first half of 24, serendipitously happened at the same time that we saw a surge in labor demand from firms as the economy was reopening. So remarkably, the economy has been able to absorb this surge in immigrants. If we think narrowly about what's happening in the aggregate labor market, it's been able to absorb this surge in immigrants without a whole lot of disruption. The labor market has expanded in terms of supply, and at the same time, we've seen an increase in labor demand that's been able to hire all these people. The labor market is very strong, both for foreign-born workers and for native-born workers.
Wendy, we only got about 45 seconds left here, but as it relates to the states and small businesses specifically that are looking for labor right now and are saying that there are shortages right now in labor, what states could actually benefit most from immigration as that is an input into the labor situation?
So I think what we're seeing is that the labor market is probably expanding just where the immigrants are coming in. So remarkably, that actually seems to be shaking itself out pretty well. We're seeing stronger employment gains where the immigrants are going. And in fact, the Hamilton Project just did an analysis of where we're seeing the surge in immigration go state by state. What's really important there is to think about the fiscal effects on those state governments and the local governments. That's really where the local issues are.
Wendy Edelberg, who is the Hamilton Project Director and Brookings Institute Senior Fellow in Economic Studies. Thanks so much. I appreciate it.
Thank you.
Certainly. Let's do a quick recap of the jobs numbers that came out this morning. 272,000 jobs were added during the month of May 2024, and we saw the unemployment rate tick higher slightly to 4.0% from 3.9% was the expectation. And then average hourly earnings came in at 4.1% year over year. Don't go anywhere. We've got even more on the Jobs Day coverage and market analysis as you're seeing all of the major averages in the red with just outside of 30 minutes until the opening bell. We've got you back again once Morning Brief begins at 9. Happy Friday. It's 9 a.m. here in New York City. I'm Brad Smith alongside Shauna Smith, and this is Yahoo Finance's flagship show, The Morning Brief.
Futures falling on the back of another hot jobs report. The U.S. economy adding 272,000 jobs in the month of May. So let's get right to it. The three things that you need to know, your roadmap for the trading day. Yahoo Finance's Josh Schaefer, Madison Mills, and Jared Blickery have more.
Investors are digesting the latest read on the labor market. The U.S. economy adding 272,000 more jobs in May, increasing significantly from April, while the unemployment rate ticked higher to 4%, the Bureau of Labor Statistics reported on Friday. Economists had been expecting 185,000 jobs to be added. The data signaling that the hot labor market remains resilient.
And shares of GameStop whipsawing this morning after the company announcing earnings earlier than expected. That stock moving to the downside here, down almost 20% in the pre-market trade. The company filing to sell up to 75 million Class A shares. Their shares again on a tear earlier this week, up as much as 37% after a YouTube account believed to be tied to Keith Gill, also known as Roaring Kitty, posted a live stream scheduled for today at noon Eastern.
Plus, NVIDIA shares are about to become more affordable. The tech giant will complete its highly anticipated 10-for-1 stock split, where investors will receive 9 additional shares for each share after the closing bell. The stock will begin trading at the split-adjusted price on Monday, June 10th.
Good Friday morning, everyone. Futures are slipping right now after the U.S. added 272,000 jobs during the month of May. That is more than the 180,000 that was anticipated. Why are the markets upset? You may ask yourself. Yahoo Finance's Josh Schaefer is here with more. Josh, why so sad?
Well, this is not the soft economic data. We're going to get a rate cut in September print that we had been following for the last month, right? If you look at sort of what the markets had started to shift and price in over the last month, it had really been a shift to softer economic data is good because it means we're going to get Fed rate cuts. You're looking at the numbers on your screen right now. 272,000 job additions compared to estimates of 180,000. You also have average hourly earnings. We know that's sort of factored into potential inflation risk increasing. That had been decreasing. That was down last month. So you have some concerns here when it comes to what it means for the Fed. And then I think when you take a look at the market, Brad, and sort of what's moving the most right now, it's futures tied to the Russell 2000, right? We talk about this all the time. Small caps are sort of what to look at when you're wondering how markets are thinking about Fed rate cuts. The 10-year up about 12 basis points the last time I looked. People are pricing out that September cut, and so the riskier areas of the market, like small caps, are getting hit.
Yeah, exactly. And we were just talking to Robert Sotkin of Citi's global economist there, and asking him just about what essentially this means for the timing of a rate cut and also just the position that this leaves the Fed in right now. And they're walking what is a very narrow, they're walking a tightrope, right? Because at one point, they cannot cut because when you take a look at that wage growth number, when you take a look at the fact that the jobs market remains very tight, although there had been signs of cooling ahead of this print, they're not in a position to cut. You don't think a July cut obviously is still on the table. And then on the flip side, the risk then of holding rates at these elevated levels for too long and ultimately the damage that could essentially in the end cause the economy.
To this point, it feels like the Fed has talked a lot about the strength of the labor market being a reason they can hold on, right? And it feels like that this report certainly feeds into that narrative, right? Which is, okay, we can hold higher for longer because the job market is still in good shape. Yes, you had the unemployment rate tick up a little bit, and that will be interesting to follow going into next month, right? Do we continue to see an increase there? I think will matter a lot. But yeah, Shauna, I think overall, you had a lot of people, when we were talking about the soft data over the last week, Bank of America's Michael Hartnett, strategist this morning, saying, you don't want too much soft data. That's not a good thing, right? That's a risk. And I think that's always important to remember when the market falls on a hot jobs report. Maybe it's still, there's something good in the fact that America is adding jobs and the economy is doing well. Yes, it might mean that your Fed rate cut gets pushed out, But we've been talking to strategists for months that say that this market might not need rate cuts at all this year.
Just to add one other number on this, because I hadn't refreshed my screen from yesterday in the CME FedWatch tool projections for September. I got a lot of tabs. That's my issue. We don't have to air that out here or just
You're airing
fully.
it.
But anyway, now sitting at about 51.6%. So a considerable move lower here this morning off the back of this
I think it was
drop.
at 69% yesterday, Brad.
Really?
Yes.
69% at one point?
Pretty big move in one day.
Massive move. All right, Josh Schaefer, great stuff. Thanks. Well, meme stocks continuing to shake up Wall Street. Another big story that we're tracking here this morning. You've got shares of GameStop now off today. 18% of reversal from the massive gains that we saw yesterday. Now the move lower today coming after the company saw revenue decline more than expected. Also filed to sell up to 75 million of its shares, more of its shares. When you take a look at this here, Brett, I think the big question, obviously, not really a question, my takeaway here from this is we have seen a lot of excitement surrounding GameStop. We have seen a lot of excitement surrounding the meme stocks. When it comes to GameStop, all of that, most of that being driven by obviously posts that we have gotten from Roaring Kitty here over the last several weeks, going back to that first post that he had on X just about a month ago. When you see the results here that GameStop had before the open, you can tell fundamentals haven't changed. If anything, they've gotten worse. Yet we're still seeing some excitement surrounding this name. So again, shares under pressure here today, but still, they're not giving back the gains that we saw yesterday.
I don't even
All
need
of
my
them.
glasses for this one. Honestly, like, what do you even say? The company is so detached from fundamentals. We knew that they would probably do this similar to what we've seen other meme stock style companies do. It's make sure that they can capitalize on when traders are hot to trot on their ticker symbol. And so what do they do during that time? And this is a button that GameStop has hit before. They tap the markets for more liquidity. And that just gives them even more of a lifeline to say, oh yeah, deliver on some lackluster results for future quarters as well, as long as they can stay in business. But one thing that I will note within this first quarter overview that they did post this morning, net sales came in at $882 million for the first quarter. You compare that to, and this is the decline that you were talking about, the prior year's first quarter, $1.237 billion in the comparable first quarter for last year. So that was down significantly. You also see them right now in this effort to actually get some more liquidity, their cash and cash equivalents and marketable securities sitting at about $1.083 billion at the close of the quarter. It'll be interesting to see what this does in terms of the issuance of 75 million more shares in trying to beef up some of their own liquidity coffers as well. But the long-term debt remains limited to low interest, fortunate for them, so they won't have to pay too much interest on it compared to what they could or should be paying.
So we've got the meme stocks. That's been a focus here of the street lately. And then we also had that hotter than expected jobs print. That's really the driver in today's early market action. When you take a look at that hotter than expected print coming in at 272,000, a little over 49% of traders now betting that rate cuts are still coming in September, down from over 55% in the prior reading. To break it all down and what this data means for equities, we want to bring in Stephen Dover. He's the head of Franklin Templeton Institute Chief Market Strategist. It's great to talk to you. So I guess first, just how would you sum up the print that we got this morning and what essentially it means for the markets?
Well, I think you got to say, hey, it's hot, 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 right? It's not only way above consensus, it's above the highest number that economists thought were going to happen. The Fed is in this predicament. This is an important number for the Fed. Why? Because they have this balance between unemployment and inflation. This is a number that kind of indicates both. Here we have this last week where there's sort of an indication inflation's down, interest rates might drop, and then we have this number this morning, which is a reverse. One number doesn't show everything, but it's pretty important indicator that the economy is still very strong. Makes it difficult for the Fed.
Stephen, we raised this question to Robert Sotkin of Citi earlier, and I'll raise it to you too. Does the Fed run the risk of remaining higher for too long?
Well, of course, that's a possible risk. I think I'm more a strategist. I'm not an economist. I'm trying to think, how does this impact investment? How do I look at this going forward? And ultimately, the way we think of interest rates is how we use them for discounting investments. And I think the implication of this could very well be that the long-term interest rates, the rate at which the Fed is going to keep interest rates over the next, I don't know, 5 years is probably higher than we thought it was before. And so that's going to affect all sorts of different investments. I'm not worried right now that the Fed is keeping interest rates too high, because this morning's numbers indicate that the Fed is current interest rates are not really pushing the economy down. The Fed's dealing with a car that it's got 1 foot on the gas and 1 foot on the brakes. The Fed's trying to slow things down. The fiscal stimulus is trying to speed things up. And so this makes the Fed's job very difficult.
Yeah, certainly. And I guess the reason why I'd asked that question to you, even knowing that you're not an economist, but it also impacts portfolio strategy. If you have a Fed that continues to say the same thing for long enough, that means that the market may look at that and say, okay, after a while, we can start to fade the importance of that, and it puts more focus on other parts of the market. And how would you evaluate that? Where would you perhaps institute any type of rotation in that manner?
Well, I think that the first rotation you have to make is that a little bit less focus on these weekly and all these numbers that are coming out. They're just swinging us back and forth and trying to think, where are we going? And I think where we're going is probably rates over the next 3-5 years are not going to drop all that much. So we're talking about whether we're going to have rate cuts this year, but the real issue is, where are we going to end up when rates finally do drop? There are some big changes. Just this week, Europe dropped interest rates. The differential between the US and foreign rates is growing. That's going to have a big impact on the dollar. That's going to have a big impact on how we look at international investments. I think one of the biggest opportunities potentially over the next few years is when the dollar finally drops and we see a rematch between valuations in the United States and overseas. But today moved in that opposite direction. Strong for the dollar.
So, Stephen, when it comes to those investment opportunities then down the line, given those expectations and kind of this reassessment that we're seeing play out in real time on the street, how would you advise investors to position themselves at this point in the game?
So first of all, you got to look at most investors, maybe not the ones on this show, but most people out there, a lot of companies have a lot of cash. They're trying to make that decision when they move that cash into fixed income. We've been advising people to move out of cash into fixed income. Today's a little mixed, right? Kind of, well, rates might stay a little higher for longer. It's maybe okay to be in cash, but we still think that the economy is going to slightly slow down. Rates are going to go down, and it makes sense to move out of cash into fixed income. Within fixed income, spreads are very tight. This is not going to help that at all. So you need to probably make your fixed income decisions more around duration and a little bit less on spread. Within equities, this is large cap positive, small cap negative. So there's a real bifurcation between those two areas. So hard on small cap companies. And then, as I mentioned, globally, Japan's cheap, other countries are cheap, but they're going to be cheaper after the end of the day because that differential in interest rates is strong for the dollar.
Stephen Dover, who's the head of Franklin Templeton Institute's chief market strategist. Thanks so much. We appreciate it.
Thank you very much. Bye-bye.
Certainly. We're also watching shares of NVIDIA this morning, ticker symbol NVDA. The chip giant stock about to get a little bit more affordable. The company is set to complete its highly anticipated 10-for-1 stock split after the market closes today. Yahoo Finance's Jared Blickery here to track the moves ahead of the split. Hey, Jared.
Hey, Brad. This gives us the opportunity to do some fun math. Fortunately, it's pretty easy. If you're an NVIDIA shareholder and you hold 1 share, on Monday morning, you're going to have 10 shares. If you own 100, it'll be 1,000. But if you take a look at the share price right now, that's going to be lopped off by 1 0. So $1,209.98, that's going to become $120, actually $121 because you'd have to round it up. So the share price will be adjusted such that the total market capitalization should not be affected. But here's a 5-year chart of NVIDIA. They already did 1 stock split a few years ago. It was a 4-for-1 split in 2021. That's this line right here. And I'll put a line chart on so you can see this a bit better. After they announced that, and they did that at their May shareholder meeting when they announced their earnings there, there, the stock doubled in price into the end of the year. And then what happened after that? Well, the world fell into a bear market, and NVIDIA actually got 2/3 of its share price just lopped off. That was a pretty big hit to it. But once it found its footing in late 2022 until the current day, that is a 10 times increase in share price. So forgive the handwriting there, but that is 1,000% of what it was. So that's pretty impressive. Now, I think we can also look at some of the other people, other members in the semiconductor space. This is actually our mega caps, but this gives us an opportunity to show how NVIDIA's ranking has changed over the last few years. Now, NVIDIA right here is number 3, and you can see it's sitting right next to Apple. It has changed places with Apple a little bit, and it's also closed above $3 trillion once a couple days ago. We'll have to see if that can be repeated, but I remember when NVIDIA was all the way over here or all the way up here, and it's been impressive to see this meteoric rise. I don't think a company has ever increased in value this quickly before at these levels.
All right, Jared, thanks so much for breaking that down for us here. We're just getting started on a morning brief. Coming up, Wall Street is bullish on Lyft following its investor day. We're going to break down those calls next. And the U.S. jobs report blowing past expectations. We are going to hear from Acting Labor Secretary Julie Su. Plus, our executive editor Brian Sazi speaking with the CEO of Campbell's Soup, getting his take on the state of the consumer. Stay tuned. That's in next hour, 10 a.m. hour of Catalyst. We've got all that for you and more. You're watching Yahoo Finance.
Time for some trending tickers. Some more positive news in the chip sector as we're taking a look at shares of Taiwan Semiconductor. They're seeing sales climb 30% in May as artificial intelligence boosted demand here. So not the best year-over-year change over the course of this year for the company, but still very positive, up 30.1% to be exact in terms of the net revenue that they saw during the month of May. They did have a booming month last month during April where net sales moved higher by about 59.6% here.
Yeah, remember that this is the biggest chip maker for Apple and for NVIDIA. So the reason why this is such huge news is really what this signals for the broader market and really detailing that AI demand and exactly where that stands. When you take a look at these numbers, clearly that AI boom is still intact, not showing really many signs of slowing down. And it's also very similar to some of the conversations I had with CEOs and CFOs out at Bank of America's tech conference earlier this week. When I spoke to the CFO of Supermicro, when I spoke to the CFO of Lam Research, they were really telling me just about that unrelenting demand that they're seeing for their chips, for their supply networks, and the fact that that is not slowing down anytime soon. The massive growth that they had seen over the last several quarters for their products, that is something that they see remaining intact now for some time to come. When you take a look at this report, it's not only really what's being fueled in the chip space, but also what we're seeing for smartphones as well. And the demand there, obviously for chips there, but more specifically, that demand rebounding for smartphones is one of the areas that had lagged over the last several quarters. So we're starting to see that recovery play out. And as a result, clearly a name like TSMC, the chip maker there, rising with sales here up 30% in the month of May alone.
Yeah, look, it's been a big week over this past kind of 2-week period even, as you think about what's taking place at Computex, where a lot of companies, and TSMC included, for a lot of the different announcements that we've seen come out from NVIDIA, from Intel, from all of the CEOs that took the stage trying to joust right now for attention within the generative AI chip demand landscape. For TSMC, and I'm going to nerd out here for a hot second here based on what I've learned from the good folks over at TrendForce as they've been kind of continuing to keep tabs on this and pulse of it. TSMC's N3E, that essentially went into production fourth quarter of 2023. And then you've got one of the other major efforts that they're having going forward here. The yield performance is close to that of an N3E, while the customer product designs have already been taped out. So what does this mean? They're continuing to innovate at the same pace and rate that many of the others who are trying to make sure that they can get the design, the fabrication, and ultimately bring all of this to market and put it in data centers. They're not falling in a ditch here. They're clearly continuing to try and maintain fabrication market share, as a lot of these other major players are certainly getting some eye-popping attention as Computex just wrapped up, I believe, yesterday, capping off this week here.
All right, let's take a look at DocuSign. It's another trending ticker here on Yahoo Finance. Shares sinking after its billings guidance for the second quarter coming in below expectations. The company, though, did see revenue in the first quarter climb about 7% from a year ago. We are seeing some pressure on the stock here this morning with shares off nearly 8%. When you take a look at the analyst commentary here, Morgan Stanley saying that DocuSign's results and guidance obviously coming in below expectations. Management pointing to several encouraging, though, demand trends near term, expressing its medium-term optimism around intelligent agreement management, one of the products there. So even though this was a disappointing report on many fronts, there is some reason, at least management trying to express that clearly to the street, reason to be optimistic in the medium term here. And again, you're looking at a 3-month chart here with gains of just around 4%. But again, the early reaction to this ahead of the opening bell, you're looking at losses of just over 7%.
Yeah, it's just a question of, what does the next iteration of growth look like? Does it need to be acquired? I mean, they did just announce, and of course, the Lexion acquisition after Q1. DocuSign closed that acquisition of DocuSmart, Lexion essentially, which is what they call a leader in AI-based agreement technology and trying to automate workflows and such. So, does that actually move the needle for getting more of the remaining performance obligations, or the RPOs, or building out the customer book and pipeline here? And I think the jury's still out if you ask a lot of the investors here today, especially if you're looking at shares right now down just shy of 8% here pre-market.
All right, let's take a look at Lyft because it's another trending ticker here in Yahoo Finance, a top trending ticker. This following the investor day that we brought you yesterday. The reason why we're talking about this today is because we're starting to see some analyst upgrades in reaction to what we heard. So the ride-sharing company getting an upgrade here from Loop Capital, from hold to buy, and a double upgrade from Bank of America. They went from underperform to buy. And then as far from the only more bullish commentary that we're getting here from the street, we also had Gordon Haskett there, analyst Robert Mullins, saying that investor skepticism on financial targets offers low risk, high reward, a call option there. So again, reason to be a bit bullish here on these prints. When it comes to B of A specifically, that double upgrade that I just mentioned, they're saying that this investor day providing 2027 targets well above the street's expectations, increasing confidence in that longer term trajectory. And I think that was really one of the questions going into this investor day, was the ability here to try and recapture some of that market share from Uber.
Yeah, and Loop Capital's Rob Sanderson essentially saying this could be a successful turnaround for the company, and a lot of optimism here that he's putting forward, looking at this 15% compounded growth rate. Gross bookings through 2027 is what that was based on. And then you look at some of the margin expansion, 4% of those bookings. So ultimately, just remarking on it and having a lot of optimism going forward from here. And so it really does come with question of where else Lyft and Uber, both of them are navigating a consumer that might be pushing back on the ride prices that they are seeing too. And that is something here, especially in New York, where thank goodness for the congestion pricing just being pushed out a little bit, because we would have directly had the hit of that.
Well, yeah, and you're exactly right to bring up that point too, right? When you talk about the congestion pricing, I'm talking about too, but when more broadly speaking, consumer spending, if consumers are under pressure, if they're pulling back, maybe they're not going to be hailing as many Ubers, as many Lyfts.
I'm going to hop on my bike.
Exactly. So that is a real risk here, at least in the short term, when you're talking about some of these consumer-facing names.
I should probably be on my bike more anyway. Up next, everyone, we've got the opening bell on Wall Street. We're riding straight towards it. Plus, after our hotter-than-expected jobs data print, we are speaking to the Acting Secretary of Labor, Julie Su, on the strength of the labor market. I mean, they should just give her the job by now. Anyway, that's right after the break. Stick with us. Oh yeah, let's go. Opening bell on Wall Street and in Times Square at the NASDAQ, where they've got the funfetti on stacks there. All right, I just wonder who sources that funfetti? Anyway, Waystar ringing the opening bell there. They get some little orange funfetti flakes that continue to rain down from the sky. And then you've got Quadratic. Oh man, PTSD from my high school days there. Quadratic ringing the opening bell at the NYSE. Talking math, everyone here. They probably do something else. But anyway, we're taking a look at the opening bell there on Wall Street and in Midtown. Let's get to it with the market open. We got some declines across the board after this hotter than expected inflation print. Investors not happy that this could signal FOMC that decides to push out to those rate cuts.
Yeah, it is a bit worrisome here, at least for the street. That's how the street is looking at this. Obviously, a hotter than expected inflation, or a hotter than expected, jobs print pointing to a strong U.S. economy. The market, though, viewing that as a negative just in terms of that timing for that first rate cut. When you take a look at those expectations, those are now being pushed out beyond the summer. So again, we're seeing that reflected in the major averages. You've got the Dow now off just around 91 points. You've got the S&P off about 0.3%, but a lot of the action coming in the bond market here today. We've got this boost in yields. You got the 10-year yield now at 441, up 13 basis points. So this dramatic move higher. Also the 2-year really moving here on the heels of this print. And then also breaking it down by sector action. We're seeing red across the board in terms of the worst performers. Real estate, materials, the utilities. Here you got real estate off just about 1.6%. Not exactly a huge surprise given the dynamics of the market right now. And also real quick, let's take a look at the NASDAQ and take a look at NVIDIA. You're looking at NVIDIA opening off just around 1.7%. So again, taking a look at this, not only because it crossed that $3 trillion in valuation, but also ahead of the stock split, 10-for-1 stock split that's going to take effect after the market closed today. Well, the May jobs print coming in hotter than expected. The U.S. adding 272,000 jobs. That was well above expectations. For more on the state of the labor market, Yahoo Finance's Jennifer Schomburger is standing by with Acting Labor Secretary Julie Su. Jennifer, take it away.
Hi, Shauna. Thank you so much. Yes, I am here with Acting Labor Secretary Julie Su for more on this morning's jobs report. Secretary Su, always great to see you. Thanks so much for joining me.
For me, too. Thank you.
The unemployment report, stronger on many metrics, but the unemployment rate ticking up to 4%. We haven't seen that level since January 2022. At the same time, the labor force participation rate fell, and the household survey showed a drop of 408,000. So are these signs of weakness to come?
I don't think so, Jennifer. You know, the numbers speak for themselves, right? 272,000 jobs created last month, and the unemployment rate is still at or below 4% for the longest stretch since the 1960s. We're at 30 months straight now. And to be honest, many people thought that even 4% was too low to get to. We would never get there, certainly not as quickly as we've gotten there, and not for as long of a time. And real wages are, continue to be very solid, and the prime age labor force participation rate ticked up a tiny bit. And, again, overall, just a very solid month. A continuation of a very solid year and a very solid economic recovery.
What about the fact that where we look at the job growth and where it's coming from, it seems to be the government sector, healthcare sector, month after month. What is that saying about the strength of the job market?
So remember, each month it has been very broad-based across many sectors. So yes, healthcare, yes, government, but also professional services, also construction, also leisure and hospitality. The overwhelming majority of growth that we've seen has been in the private sector. And so there's just, it's just overall such a strong, steady, stable, continued growth that I think this is certainly the coveted soft landing that many people said wouldn't happen. And again, none of this was promised. None of this was inevitable. It happens because of steady leadership, and that is what President Biden's economic agenda has always been about. This broad-based growth, investing in America, creating more good jobs, creating more opportunity, and we are seeing the results of that in the numbers.
So you think we are here? We've gotten the soft landing?
Yeah, I mean, it's such a hard answer just because we're always keeping an eye on what's going to happen, right? And we got to continue to do the good work. We got to continue to, invest in good jobs. We have to continue to make sure that there's safe roads and bridges and bring manufacturing home. All of this work is the continued work of this administration. But yes, I don't think there's any way but to say that the numbers don't lie and say that this is a soft landing. Strong job growth, low levels of unemployment, high labor force participation rate. It's all the things that you would want.
How much of this is owed to immigration? Goldman Sachs had some stats out this week. They said they think that 80,000 jobs per month last year were owed to immigration. This year they expect a tailwind of around 50,000. How much do you think immigration is adding to the story?
Well, immigration has always been a part of our labor force, right? Part of our talent pool. That's been throughout history. And certainly immigrant workers are part of this story too. Now, the majority of the jobs that have been created have gone to native-born workers. So I think that's important too. And what it really tells us is instead of an economy where we have a shrinking pie that has to be divided up among more people, we are seeing a bigger pie overall. That's what the job growth demonstrates, right? That's what the over 15 million jobs created since the president has come into office, the most of any president in that same time period, tells us. When you create a bigger pie, there's more for everybody.
How do you see President Biden's new executive order on the border impacting the labor force?
Well, we don't really see an impact on the labor force at all. I will just say, as the acting labor secretary, I think it's important to emphasize that all workers, regardless of status, have the protections of labor laws, and that's why we keep talking about good jobs. Like, we want everybody to have a good job. That's why this summer I'm going to, I've just launched our Good Jobs Summer Tour, going to cities across the country to talk about the jobs that are being created, to talk to working people and their families about the impacts of those good jobs, and to really highlight that this is fundamental to the president's vision of how we build a strong economy and strong communities.
One major highlight of this report is the women's participation in the workforce, hitting another record high for a second month in a row. Secretary, what is this owed to?
I know we've talked about this here, that women have in so many ways powered the economic recovery that we've seen. And as you said, yet again, the labor force participation rate for women reached another all-time high. This is the highest since this data was collected first in 1948. And as you also noted, the second month in a row, and actually the third month total since this president has come into office. So this is what an equitable recovery looks like. This is what it means to create opportunity for all. And historically, we know that women come into the labor market when there are supports for them, and one of those supports is when the wages are higher and there are good jobs. Women look for work, and they're finding it.
And if we were to have, if childcare were more affordable in this country, would we see even higher numbers? And what would that mean for economic growth?
Yes, I mean, I also will never get tired of citing. We did a study here that demonstrates that if this country invested in childcare, like truly, affordable, reliable childcare, which we know remains a challenge, but also good jobs in childcare, which would help with the supply of childcare, then it would allow about 5 million more women to come into the labor force, and that would generate $775 billion of economic activity a year. So I always say, we can't just talk about can we afford childcare. We have to recognize that how can we afford not to invest?
Secretary Sue, thank you so much, as always, for your insight. I so appreciate it.
Thank you. So wonderful.
That's Acting Labor Secretary Julie Su. You're watching Yahoo Finance. We will be right back after this.
GameStop shares halted amid volatility in the stock. You have shares halted right around of a drop of 5.5%. Yeah, just around 5.5%. So pairing some of those earlier losses have been off over 15%. The company announcing its plans to sell another 75 million shares, also releasing some of the latest sales figures there, showing a decline worse than expected, really showing the fundamentals clearly have not changed at the company. No surprise there. But again, increased volatility surrounding this name. We also have Roaring Kitty Keith Gill expected to speak right around noon Eastern time today. So that, of course, led to the rally that we saw in shares yesterday. So again, GameStop halted for volatility in early trading.
I mean, it's basically a blizzard of different events that are taking place here. You have share price dilution with the additive 75 million shares that are going to be introduced into the market. Then you have the fundamentals that are continuing a trend of being bad, as they year over year declined from $1.237 billion in the prior year first quarter now to $882 million in net sales for the first quarter, and that based on the stats that the company released this morning. And then, oh yeah, you've still got a ton of the retail trader activity that's really going to be prominent and potential to really move the stock around in many different directions. I mean, as you mentioned, we're going to be standing by for one potential major announcement over YouTube. We'll see what that is, or just an update. We've gotten YOLO updates from an account believed to be Keith Gill posting to this juncture. So all of these things considered, you're seeing yet another trading pause. We had already seen this happen 4 times in one day during May as well. So all that considered, we're continuing to track shares of GME. Everyone, we've got all your markets action ahead. Stay tuned. You're watching Morning Brief.
Palantir shares have been on a tear this year. The stock up just around 40% since the start of the year, driven by excitement surrounding the AI boom. In an exclusive interview with Yahoo Finance, Palantir CEO Alex Karp discussed the company's AI platform and ultimately what it means here for customers and investors. Take a listen.
What they're going to find is the large language model is much more like a chemistry experiment, the outgrowth of which is something that is useful when refined, where we impose the logic of your business on the large language model in the security and intellectual logic of your business. And this is transformative. And what it means for investors and others is there is value in this market. You can identify where the value is very easily.
Joining us now, we want to bring in Brent Thill. He's a Jefferies senior analyst. Brent, it's great to talk to you. So taking a step back here, when you take a look at Palantir shares, they're up just around 40% since the start of the year. Lots of questions just around the hype surrounding this stock. Clearly, it's been a wild run for some investors. I'm curious just your take on the current position of Palantir right now. I believe you still have a hold rating on the name.
Yeah, good morning. Fundamentals are obviously improving at Palantir. What holds us back right now is valuation. It's the single most expensive name in our coverage universe. So great companies with great momentum sometimes look expensive on the opportunity set. And we obviously believe the opportunity set is enormous for Palantir and AI, but we believe there's going to be better entry points for the stock. The fundamentals, they've done a really nice job. You know, the beginning of last year, for basically 75% of the year, they didn't produce anything. And then in Q4, things started to turn. They really cleaned up all the bad execution last year in Q4. And then in Q1, they had a really good number. So you've had 2 good quarters. I think they got in front of the AI wave better than others. Clearly, AI is really an infrastructure. If you look at what's happening with NVIDIA and all the other names, it really hasn't come to the software layer. Palantir is bucking that trend. They have seen great momentum in their suite, and customer adoption has been good. So give them credit where credit's due. They're doing a fantastic job there. But again, you go back to multiple being the single richest name in software. So you have valuation risk right now. You don't have fundamental risk. The fundamentals are really good.
Yeah, I mean, it's particularly interesting too when we hear Alex Karp talk about the biggest use cases and how important their company is and their estimation or calculus for what they believe the world could move towards, unfortunately. And it really is trying to figure out which governments, which companies are best trying to position themselves if we do see even more geopolitical tension. How much of that can be part of the thesis into why Palantir would succeed rather than other factors?
It helps. So, you know, half their business is government, half of it's commercial. The commercial business is doing really well. The government business isn't doing as well, but is still a bright spot. And so certainly more tensions, you know, you effectively need software to effectively do scenario planning, to do disaster planning, to understand, you know, what assets you have, where should they be. So they've always thrived, you know, in that part. I think that the challenge for investors on the government business is, one, it's hard to really talk to the CIA or whoever has the software to really actually see what it's doing and does it work, right? So what we've said to investors is the government business is really difficult to analyze because it's hard to talk to most of those governments. They don't want to talk to anyone about how they're using it. It's very secretive. So you effectively cannot predict what happens in the government business. On the commercial side, we can do a better job of that. And I think that's where we're seeing great success. United Airlines, a handful of the other great case studies that they're getting, those are real case studies around supply chain, aircraft maintenance. They're doing a really nice job there. So the government business has been, in our opinion, it's going to be it's great, but you're really going to be able to do the work in the commercial business, and the commercial inflection is happening. And I think this is the area that needs to continue to improve because the government piece is just unanalyzable. You don't know when it lands. They're big deals. You don't know when one country is going to buy the product or another, and they tend to be massive deals. They tend to not, you know, be little deals, or they're huge deals. So when they land, it's difficult on timing. So no doubt it will help them. And I think their position in AI and the success stories that they're getting now are really going to be what's going to keep investors really excited, which is when they launched this company, it was like when Musk launched the Tesla. It was unaffordable for 90% of the population. Now nurses and interior designers and accountants can buy the Tesla because they brought it to the mass market. And Palantir is bringing this now to the mass market. That's what is exciting me the most. At the beginning, it was really built, again, for special people that have special budgets. And now they're trying to effectively change that by saying, hey, you can go into a boot camp, you can buy this product for your supply chain, you can get it up and going, and if, in a month or two, get value and then build into it if you get success. That's a great call. We love that strategy. That's the same playbook that Elon Musk ran. So, hats off to them. We missed part of the move in the stock, but I also think, you can be patient given some of the valuation concerns that we have.
All right, Brent, fair enough. I want to switch gears here just a bit and talk about Microsoft, because we have regulators here continuing to crack down on big tech. Now the DOJ and the FTC reportedly planning probes into NVIDIA, OpenAI, and Microsoft. But let's focus on that Microsoft part of it here, because when it comes to your coverage here, the questions surrounding regulators and impact that is going to have here on some of these larger cap names, and Microsoft's partnership with OpenAI already facing probes overseas in the UK and the EU. How big of a risk do you see this as a risk here for the company?
I don't see it as a risk at all, because all regulatory overhang concerns have always been bucked by big cap tech. If you were worried about Meta or Google or Amazon or Microsoft, you missed the picture. You missed it. And none of these issues have been an issue. The regulators do what they do is to protect you and I as consumers, and it's their job to investigate. Ultimately, how Microsoft and these companies deal with it, I think, is the important thing, which is they're adding value to how we work every day. And if they did it in a legal, compliant way, then there's no issue. So I don't see an issue. There hasn't been an issue, and the playbook in tech is on the best tech names, regardless of what regulatory overhang there is, and that's worked. And that's been my thesis for many years, and I think it's worked. So now in the age of AI, I'm not sitting here saying, things shouldn't be regulated. That's not what I'm saying. What I'm saying is we should have clear laws and rules, but you can't regulate when there's no rule book. And this goes back to when Facebook was $100 a share and Zuck got investigated. And I'm like, there's no playbook or no rule book. So don't make up the rules on the fly, set the rules, and then if they don't follow them, then they're in trouble. But you can't make up rules in AI when there is no rule book, right? So we need a rule book, we need regulation, we need to protect all of us. And I think ultimately Microsoft is a company for the last 20 years I've covered. They've only wanted to help consumers. They're not going to launch something that's going to hurt us. It's going to help us. So as long as they follow that playbook, we're fine. Keep owning these stocks. Any regulatory pullback in the stocks, you buy the weakness.
All right. Good to hear that Microsoft is not going to hurt me going into the weekend. Brent Thill, Jefferies senior analyst. Brent, great to see you. Thanks so much.
Thanks.
Let's talk a little NVIDIA here. NVIDIA briefly topping Apple as the world's second most valuable company this week, but could the tech darling's run soon hit the brakes? According to S3 Partners, there are about $34 billion in outstanding short bets against the chip giant. That's about the same amount short sellers have bet against Apple and Tesla combined, though, according to data analytics firm. So ultimately, this is all coming ahead of NVIDIA's big stock split, where if you look at some of the historical performance, 12 months after, and this is according to BofA research, 12 months after you see a stock split, they tend to beat the index. The company initiating the split tends to beat the index here, and the return is typically about 25.4% versus the 11.9% return of the S&P 500 here. But the shorts certainly are adding up, at least in this near-term period of time.
The shorts are adding up, and this is going to be interesting to watch here when you take a look at NVIDIA following suit of some of the other larger cap tech names in splitting their stock here over the last several years. I believe it's the fourth Magnificent Seven name to split their stock over the last several years. So you take into account exactly what this will mean for shares ultimately in the short run. It could be a little bit of a boost. It could provide a little bit of a gain here for shares. But like many of the strategists that we have talked to over the last couple of weeks since this was initially announced, they're not exactly expecting this to be the main driver here of the stock. And any sort of movement that we are going to see is going to be more of a blip than anything else. But again, the data from Bank of America was interesting just in terms of that outperformance. But when you take a look at their full chart there, you can see there is clearly a discrepancy when you break it down by decades and the outperformance versus underperformance of what we had seen. But overall, that average was just around 25%. So clearly outpacing those that did not over the last several years.
I know you see me grinning sometime, and it's probably just ignites fear because it's just like, what the heck is he about to say? But I would say this. If Jensen Huang and NVIDIA are able to deliver another Goldilocks report after this quarter, he needs to take a page out of Elon Musk's playbook and just go after some of these short sellers and start selling some all-leather shorts, but short shorts, like the ones that the guys are wearing out this summer here. Just I won't go into too much, but ultimately, Maybe he needs to do that.
Leather shorts are in? Is that my takeaway from this?
I'm not saying they're in. He just wears leather jackets. Want to have some leather shorts that go with it. Some, leather shorts.
We'll see. Yeah. Maybe you're onto something.
Elon did that. Yeah.
Questionable. All right, well, coming up, we dive deeper into the May jobs print and what it ultimately means for the Fed. Our executive editor, Brian Sozzi, also speaking with the CEO of Campbell's Soup when we talk about the consumer. We've got all that and more on Catalyst next. It's 10 a.m. here in New York City. I'm Shauna Smith alongside Madison Mills. Let's dive into the catalyst of moving markets this morning.
The latest jobs data coming in hotter than expected, with the U.S. adding 272,000 jobs in the month of May. The acceleration in hiring could be the final nail in the coffin for any potential July rate cut. We're going to discuss the market implications.
And shares of GameStop are falling. They were briefly halted numerous times since the opening bell. Now the company releasing earnings early, also filing to sell up to 75 million shares. It had been down significantly in early market action. Then it had regained those losses. Now we're back trading to the downside. Looking ahead, we await meme trader Keith Gill. He's set for a live stream on YouTube at 12 p.m. Eastern Time.
Plus, Apple and Nvidia continuing the battle for market dominance. Apple once again has the second largest market cap, just by a hair here. We're going to discuss which Mag 7 name has the juice to keep investors happy moving forward. But first, the big story today is the May jobs report. The U.S. added about 90,000 more jobs than economists had anticipated. We also saw year-over-year wage growth tick higher to 4.1% for the month. The Fed swaps market no longer fully pricing in a rate cut before December, with the labor market remaining red hot. What can we expect from the Fed? Joining us now to discuss, we have Satyam Pandey. He is the S&P Global Ratings Chief U.S. Economist. Thank you so much for being here with us, Satyam. Appreciate it. We were talking before coming into today's print, you had a December call. How much more conviction do you have now?
Well, I think I have more conviction from, what the upside surprises that came out from today's labor data, especially on the wage side. And it's good to have wage growth running at 4% if you are a household sector. But for the Fed, they would probably have liked to see a little bit sort of a continuation of that downward glide that we had been seeing, just so that the demand-led inflation pressures would start to subside.
Yes, Satyam, I'm curious how you think this is going to affect the messaging, the narrative coming out of the meeting next week.
Yeah, it's going to be quite a balancing act that they have to do in their communications. I do think that they would have to revise their own rate cut projections to maybe perhaps one rate cut for this year now. They had two last time, just because the inflation has surprised on the upside in the first quarter. But having said that, I think we are at that point where things will perhaps moderate slowly rather than just fall off the cliff, right? So it's a good situation to be in. They can, they have the labor market on their hands resilient enough to hold through, December. So
I guess my question also at this point of the cycle and the fact that we had a jobs print as strong as it was here, blowing past the street's expectations, is the current policy, is it as restrictive as maybe we initially thought it was, or should we be rethinking even how restrictive that current policy is at this point?
Well, at this point, when you look at the interest-sensitive sectors like the housing or some of the business investments, that they have gone through quite a bit of correction since, the first rate hikes. It does seem to me that maybe perhaps just holding at this current rate is probably the best, policy rather than trying to tinker around the edges at this moment. But they will be more, in tune to the upside inflation surprise still, rather than the downside inflation surprise. So that gives me, what? Yes, we have a December for the base rate cut right now. It could be pushed out. Yeah.
The data, though, was a little bit confusing, and as always, I could pick any data point to support any view I have about the Fed moving forward. One I want to point out, though, the number of people working multiple jobs in the U.S. hit a record of 8.4 million in May. That is the highest it's been since before the pandemic. Is the data here, when you take a step back, is it showing good growth, or is it showing an economy of people who are starting to struggle with inflation, and could that be a sign of a potential drop-off that we're not anticipating right now?
Well, so there are a few things going on here. There's one survey showing very solid growth in payrolls that's coming from the establishment. And there's a household survey, like the one that you just mentioned, that is showing multiple job holders increasing, part-time job holders as a share of the overall. That's also increasing, and it's been going on since last year. So this has been on an increasing path. This is not something new. It generally tends to happen towards the later half of the cycle, a business cycle, where more folks on the sidelines tend to come in. They have more reasons to come in when there's higher wages. They have more reasons to do multiple jobs just to secure those. If it's available, why not, kind of. So that's the optimistic view of the same number.
Sure.
You can get the pessimistic view where you think, you know what, these guys, inflation is probably eroding their income because inflation is high. And in real terms, they probably need to have a second job just to meet their ends. And that sort of gives you the more pessimistic view. Huh?
Satya, when you take a look at that wage growth number as well, just in terms of how worrisome that is, what this ultimately means here for the Fed's timeline, and just how difficult that final mile is going to be for the Fed and its ultimate goal to bring inflation down to 2%. What does that tell us about maybe what that more realistic timeline could potentially look like?
Well, I think the last mile was always going to be a bumpy one. And these data, they tend to be revised quite often as well. Even the data that you are seeing today, because of what some other benchmark data have been saying, it may be revised down, right? And there's a divergence between the unemployment rate number and the employment. So with all this, wages itself, it seems like the quit rates, the dynamic labor market is kind of, slowing, and that should give wage pressures moving down as the year goes by. That should help inflation, at least some part of inflation, move down to more normal levels. We do expect inflation to continue moving down. Maybe perhaps by next year in the fourth quarter, it'll get back down to 2.2, 2.3%. But we're talking about next year, not this year.
Well, next week, we get another dot plot. So I just want to get a number from you. Best guess for the dot plot next week, 1 or 2?
Oh, they're going to have 1, I think. I would be surprised. Just given the upside surprise we got in the first quarter, that should automatically feed into their, base numbers. And if they don't, then we would all have to think about their response function. If perhaps it has changed the way that they see, they will reveal their preference, right? So it would be a good report to look at. I would be quite surprised.
All right, Satya, it's always great to have you here in studio. Thanks so much for joining us.
Thanks for having me.
All right, let's move on to another top story that we are watching, and that's the meme stocks. GameStop was falling here initially, have been halted several times since the start of trading. It's been all over the map, and you're now looking at losses of about 17%. The company announcing plans to sell up to 75 million more shares, also releasing earnings early that were a bit of a disappointment. Ines Ray has a closer look at some of that movement that we're seeing here today. Ines.
Yeah, Shauna, and the GameStop saga took an unexpected twist this morning as the company, as you mentioned, unexpectedly dropped its latest quarterly results and filed to sell more shares. Now, this all comes hours before that YouTube channel, believed to be linked to retail trader and investor Keith Gill, announced that that live stream is going to be happening today at noon. So let's take a look at what the results are. Net sales dropped 29% year over year to $882 million for the quarter versus estimates for $995 million. A loss per share came in at 12 cents versus estimates for a loss of 9 cents per share. Net loss narrowed to $32.3 million compared to more than $50 million for the same period last year. So between these results and the share sale plan, the second one, by the way, in a span of about a month, the stock is down. You're seeing in early trading. This comes after also shares had surged yesterday 47%, and then they gained another 30% in after hours yesterday. This is after that YouTube channel, believed to be linked to Gill, plans to hold a live stream today. And the alias on Reddit that also is believed to be linked to Gill posted its portfolio with GameStop stock and unexercised call options ballooning to more than $500 million with unrealized gains of more than $380 million. Now, a lot has been said about whether what Keith Gill, if it's him, these postings, whether these are legal or not. We have spoken to experts about this. Look, also, I do want to note that when these posts come out on these portfolio holdings, you'll recall that they come out before the market open or after the market open. So it's not during market hours. We do have to say that, guys.
All right. Thank you so much, Inez. Really appreciate your insights on this name that continues to whipsaw. Let's say that.
Yes.
Coming up here, NVIDIA briefly passed Apple to become the second largest company based on market cap. But who is set to hold the position in the long run? We're going to discuss when we get back.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
and expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
With U.S. hiring trouncing expectations, the big question, is this a sign of growth or a sign of a lot of inflation the Fed's going to have to fight? For more, we bring in Nancy Tangler, Laffer Tangler Investment CEO and CIO. Nancy, thank you so much for being here with us. You had a great note that was really informative for me heading into the jobs report, so thank you for that. But I want to get your take on it because you noted that we are starting to see some cracks, particularly in the lower end consumer, with personal savings starting to not keep pace with the wage increases that we are seeing here. We're seeing these cracks come up in consumer earnings as well. So I'm curious from your perspective, when will the cracks in the lower income consumer start to cause a problem, not just for the Fed, but for markets?
Yeah, Madison, thanks so much for having me. I think this is a slow decline. And, we got the numbers today that show average hourly earnings up somewhat and revised upward, but these numbers get revised dramatically. And so you have to pay attention in the near term. And so you have to pay attention to the long-term trend. And what we're seeing is that average hourly earnings have declined to about 3.9 to 4, depending on which number you're looking at. Personal savings rate is down now to 3.6, which is well below pre-pandemic levels of 6.1. So sort of taking out the COVID checks that popped up personal savings. And then access to credit is declining. And so I think what we've seen in retail is a tale of two cities. The lower end retailers, ex Walmart, and there's a reason for that, have really shown difficulty in hitting their numbers. But then you have a name like Chipotle, which continues to delight shareholders, and we're one of them, with price increases, but also cost management and then growth. And so you really do have to pay attention to which retail company you own, because the consumer low end is getting crunched by inflation pretty severely and by higher mortgage rates.
Nancy, I'm curious, before we dig a little bit deeper into some of your positions and your views on particular stocks, if we just take a step back here and take a look at the market's kind of whipsaw reaction to this print. We have the S&P and the NASDAQ still in negative territory, but now you actually have the Dow back trading above the flat line. I'm curious just to get your take on this almost whipsaw event that we have seen here in the markets, and maybe the downside losses that we saw shortly after the print. Was that a bit of an overreaction?
Yeah, Shauna, I think when you're looking at these things minute by minute and day to day, the algorithms in the hedge funds have an outsized impact on the markets. So what you see typically is you get these violent swings, and then the institutional investors, ex hedge funds, are come in and look for opportunities. I mean, we like the volatility that the hedge funds create because it gives us an opportunity to step in and take positions at a more reasonable price. So that I wouldn't pay attention to the violent swings in the day-to-day levels. I would pay attention to the long-term trend. And we are in a bull market, and I think we'll continue to see stocks at the margin go up over the medium term.
Nancy, this brings me to your commentary about hedge funds piling into NVIDIA in particular. If there's opportunity to go against the grain of hedge fund movements, where is the opportunity when they're piling into a name like NVIDIA that's driving this market rally? How do you kind of follow that wave, but also find areas of opportunity outside of it to gain an edge?
Well, it's not easy, Madison, but what we saw from Goldman Sachs was that the last week, selling in technology was the worst than it had been in 11 weeks, which is still a very short time period, right? But and it was 60%. The selling was 60% in software. And so what we've been doing is looking for some of the higher quality names that we own and looking for opportunities to add to those. And so that was why I suggested in my notes that even though it's an obvious name, Microsoft is interesting to us here because it has underperformed year to date. The most of the names in the Mag 7, and it gives you an opportunity to pick away at a company that we think is going to be an easy winner in AI and is going to benefit from AI PC upgrade cycle.
And Nancy, I believe that you're also seeing some opportunity within Amazon as well. So is that a similar investment point? Is it all about AI? Is it all about the growth there? Or what is it about Amazon maybe that you also find attractive at these levels?
Yeah, so Sean, both those names are hyperscaler cloud computers. And so cloud computing stories, sorry. And so what we saw last quarter was that Amazon, the big gorilla, was up about 17% last quarter year over year in terms of cloud computing, and Microsoft's Azure was up 31%. So when there's all this debate going back and forth about whether or not who's going to benefit from AI, we think that both of these names will be winners. And so you want to be positioned in both. Plus the other aspects of Amazon, ad growth, the retail side of the business, and Amazon Prime Video, we think it will continue to be drivers of growth. Andy Jassy is really, when he stepped in, he got what we called Tim Cooked. There was, a lot of doubt about whether or not he could run the company, as there was with Tim Cook at Apple when he took over. This is what happens when you follow an iconic CEO. But in general, we think he's done an excellent job, and the company is poised for growth.
I want to end, Nancy, where we started by taking a look at the macro. The Fed is telling us that they're going to respond aggressively if we do start to see evidence of a potential significant slowdown. I don't know that the market is necessarily priced for that potential risk. You tell me, but how should investors be positioning themselves to hedge against that potential risk of the Fed moves against any potential recession elephant in the room?
Yeah, Madison, I don't see it. I mean, I think yesterday was instructive. We had a very bizarre press conference from Christine Lagarde at the ECB. They cut rates, but they raised their inflation forecast. I think the central banks around the world, we got a cut from Canada, and we've seen some in Europe from Sweden and Switzerland. They want to cut. They believe that maybe they're restrictive more than maybe the rest of us do, but they want to cut. So I don't think we're going to see a hike from the Fed. And I've drawn an analogy for about a year now to the 1990s, where you had productivity saved the day, and Fed Chairman Greenspan understood that. And so he did cut rates 3 times in 1995 after raising aggressively in 1994, and then held them constant. So I'm not saying we're going to get 3 cuts, but I think the odds are that we get a cut rather than a hike, and it will be later this year. And I think investors are also, I think that's why you saw the market to some extent come back, because this notion that we're going to get a hike, I think, is not well founded.
Well, Nancy, since you bring up the ECB, I'm curious. We saw that folks maybe weren't anticipating the idea that the ECB could be one and done, at least for the short term, in terms of cuts. What is the potential risk of that being the case for the Federal Reserve, that we're all anticipating this potential cut, but then they might cut and then wait for a long time to do another one?
Yeah, I think that's entirely possible. And I don't think that's necessarily bad for stocks at all. And what we saw in the 90s was higher interest rates and robust stock returns could coexist. I was managing money then, so I remember it very well. I didn't just read about it. And so I think that's one of the things that investors maybe are starting to sniff out. And in particular, technology companies, and the 2 names I mentioned to you, are beneficiaries of higher interest rates because they have a ton of cash on their balance sheets. And so their interest income has grown dramatically over the last couple of years. So I do think there will be losers in this environment, but there are plenty of places where if you're paying attention and picking, high quality companies, you can outperform and enjoy nice returns in this environment.
All right, Nancy Tangler, Laffer Tangler Investments CEO and Chief Investment Officer. Thanks so much for joining us here this morning. Have a great weekend. All right, well, NVIDIA becoming the 3rd company in history to cross the $3 trillion market cap mark this week, following Microsoft and Apple. The company also briefly passing Apple to become the 2nd largest company by market cap earlier this week. But the question is, who can hold that position in the long run? And Maddie, when you take a look at the performance of these 2 names, really since the start of the year, we certainly did see a bit of discrepancy when you're a wide gap in terms of the outperformance that we saw from NVIDIA, in terms of the fact that Apple was taking a bit to catch up. And that was something that had played out towards the end of last year as well. And you can see it up there on your screen, just about the excitement surrounding NVIDIA, with the stock now up just around 140% since the start of the year. In terms of that outperformance and the catalyst here for the name, when you talk about Apple specifically, I think we all know NVIDIA's investment story. That's not so much changing anytime soon. I think the street's consensus on NVIDIA, there's still reason to be bullish. You had Bank of America's analyst there coming out earlier this week with the street high price target of $1,500, just talking about their continued dominance within the space. But I think the question for Apple and really that future performance, a lot of that might hinge actually on what we hear at the Worldwide Developers Conference next week, and exactly what their plans are for AI, how they're planning to incorporate AI technology into their products, specifically the iPhone, and then ultimately what that's going to do for the upgrade cycle and the demand there for future phones. So I think that's critical in the Apple investment story, and what could potentially be that next catalyst here for shares moving higher.
Well, I feel like you had great insight into this week, Shauna, with your on-the-ground reporting for us from this tech conference, right? I feel like you were sending us information from your sources about what they were saying about AI spend and how to kind of differentiate between the spend that's going to be useful and the spend that's just throwing spaghetti.
Yeah, and that was so interesting. And that was through my conversations with the Nutanix CEO, Rajiv Ramaswamy, and then also the founder of Pure Storage. And they were basically saying that, yes, there is reason, right, to be so excited about AI boom. It is real when you talk about the material impact that it's having on so many of these companies. But at the same time, there almost needs to be this reality check, right? Just in terms of what is a realistic timeline when it comes to consumer adoption. What does this ultimately mean in terms of the impact that it's going to have on people's everyday lives? And when it comes to that aspect of it, there were some questions raised by those two executives just about the fact that maybe we have gotten a little too excited at this point, and maybe those expectations aren't necessarily realistic. And as a result of that, we could see some shakeout that happens within the industry, and specifically the impact that we could see on some of those smaller companies, the startup space. But again, when you take a look at the leaders within AI, obviously NVIDIA, when you take a look at the leaders overall within the tech space, Apple, and you talk about their plans for AI, there is reason, it seems like, to be optimistic at this point.
Yep.
All right. Well, coming up, we've got a lot more for you here on Catalyst. Exxon getting a downgrade from Truist, predicting that it's going to underperform its peers. Despite that, though, you're looking at gains of about 0.4%. We've got that and more trending tickers for you when we come back.
Let's get to some trending tickers here. ExxonMobil hit with a downgrade by Truist, taking the stock from a buy to a hold rating. Truist also trimming its price target on the stock here. Those shares recovering a little bit here, up by 0.5% earlier in the trade. They were down close to 1% in pre-market trading in particular after this downgrade. Now we are seeing a lot of positive movement in the overall oil space today as energy stocks are recovering. They were on their highs earlier this week after 5 straight days ending in the green, but then we saw a little bit of a selling off there, Shauna. Now we're seeing a little bit of a recovery in the space. Having said that, just to pull out a quote from this particular note, they say, while we continue to believe that Guyana, a world-class asset, and the Pioneer acquisition for Exxon was positive, they're forecasting shares to underperform peers near term given current valuation. So that's interesting to me. They're specifically calling out the valuation piece, and then they mentioned free cash flow yield trailing peers well into 2025, decreasing that price target to 124 from 146 there.
When you take a look at the performance of this stock here, since the start of the year, it is up just about 12%, nearly 12%. When you take a look, even the gains that we've seen over the last month is actually off just about 1.5% over the last year. Those gains much more moderated, up about 5%. So I think there's questions just about ultimately the driver here of the business, what exactly demand is going to look like for crude here. You mentioned Guyana, some of the points that were pointed out within that Truist note and the calling here into question of the current valuation. So it was enough, at least for some analysts, for Truist to go to a hold on the name, slash its price target here. Again, though, it's not having much impact on the stock here, because here we are today, Exxon still well above $100 a share. It's up on your screen, $114 a share, and that trend had been to the upside here, not so much on the one month chart that we have there, but since the start of the year has been on this uptrend. So again, we will see how this all shakes out. And of course, the question with Chevron's also a recent deal here, and some of the other M&A deals that have been done within this space, just how much that is going to shake up the sector and some of those future gains here over the next several quarters and several years. So again, Exxon shares year to date, we're still looking at gains about 14%. Taking a look now at Samsung Electronics, the labor union representing tens of thousands of workers at Samsung staging a walkout, marking the first ever strike in the company's history. Now, this is significant because we have seen this movement really across the globe here of workers taking a stand in their demands. We're seeing that affect Samsung here, the union workers staging that walkout for the first time. Of course, the question is here for investors, just ultimately any disruption, what this could mean here for the business here going forward. Obviously, too early to tell on that. But again, it was trending here on our site, and I think a lot of that points to some of this movement that we're seeing, but also ultimately the question there just about any disruption in terms of production and what that would ultimately mean for Samsung's bottom line.
Absolutely. I mean, this comes as they're obviously trying to prove themselves as a company that can really play in the chip space, meet the intense demand for chips. Internal company volatility, not going to be great for that story. Now, this was the world's largest chip maker, reminder, until back in 2017. I'm so sorry. Let me correct that. Intel was the world's largest chip maker until 2017, when Samsung started to surpass it in revenue. So seeing that competition between those two playing out in Taiwan, in Asia over the past couple of years, but also specifically over the past week when we've seen these competing companies announcing chips news after chips news. So continuing to cover that story as this strike continues to happen here. Moving on to Moody's setting sights on 6 U.S. regional banks, placing a downgrade review amid concerns over commercial real estate exposure. Some of the lenders on the list, including Merchants, Fulton Financial, and Old National Bank Corp. You can see that some of those names moving to the downside this morning. Big movement for Old National Bank Corp, down over 1%. Not a massive surprise when you think about the pressure that regional banks have been under amid the higher interest rate environment, pushing a lot of deposits out. We've seen this flight to quality and higher rates, things like high yield savings accounts. This is why we've seen such positive movement in the big banks when we talk about earnings season kicking off with the likes of JP Morgan, Goldman Sachs, Morgan Stanley. That pain is going to be felt elsewhere. And these are companies that don't necessarily have the capital on hand to be able to withstand the higher for longer environment that's causing that deposit flight, but also causing issues with their own balance sheets through things like commercial real estate pressures. Shauna.
Yeah, exactly. And we've really seen investors take note and focus more in on some of these names following everything that's played out with New York Community Bank Corp and their exposure to the commercial real estate sector. More specifically, that wasn't very much a regional story, very much focused on New York. But again, when it comes to these names, again, a very, very similar picture. So not necessarily a huge surprise, given the fact that Moody's has placed these 6 regional banks on review for a downgrade. So the talk about the CRE and the weakness there has kind of started to quiet just a bit. And we did start to see maybe a shift in narrative or tone surrounding CRE. But I think the worrisome calls out there from many who are closely tracking the sector is that still this is an issue that could be with us here for years to come. As many more of the loans become due, as many more of the leases are tried to be renewed, that could be a real issue here in the coming years, which has still caused many people to stick with their initial calls that this could be the next shoe to drop when it comes to some of the weakness that we could see here within the economy.
Yeah.
All right, well, we've got much more of your market action ahead. Stay tuned. You're watching Catalysts.
Campbell Soup out with its latest earnings. Lots of things to unpack in these results. Let's bring in Campbell Soup CEO Mark Klaus. Mark, always great to get some time with you. I just want to let's start on the Sovos integration. I mean, this is your big acquisition. We'll talk about earnings, but what are you seeing in these early days? What do you like? What should investors expect?
Yeah, well, I talked about this a lot yesterday, and it's great to see you, Brian, as always. Look, I think in the world of having done a lot of integrations and a lot of acquisitions over the years, this one literally could not be going better. Across the board, when I look at the elements that, and again, fair, it's early days, but when you look at the elements that indicate positive acquisitions in general, you're looking for really affirmation of a lot of the diligence that you've done, and across the board, we see check marks on everything. I think what's been a pleasant surprise is that the growth on the business has actually accelerated from the time of announcement, which you don't always see, and has been really, really powerful. And I think across the board, whether you're talking about pasta sauce, whether you're talking about some of the category extensions, whether it was soup or dry pasta or frozen pizza, these are just tremendous positive contributors to growth. And as we laid out a year ago, we looked at the things or the reasons to believe for why the growth would continue. And a year later, I can tell you across the board, we've checked every box. And then finally, I just would say, what a gift to get the members of the Sovos team as part of the Campbell's family. I mean, they are tremendous. They've done a great job, hit the ground running. And so really, I got to say, Brian, across the board, we're feeling great.
I've told you this before, but I always view what you sell and what doesn't sell as a great snapshot in the economy. Now, you just mentioned Rayo's pasta sauce, that's accelerating. Prego pasta sauce, that was pretty good in the quarter. Why is pasta sauce resonating with households right now?
Yeah, so, clearly, Brian, you and I have talked about this before. Consumers right now, although there's a lot of reasons to believe in recovery and improvement, it's important to remember, though, that for many consumers in the country, they have been weathering this storm of inflation, of higher interest rates, really pressure coming from all sides for a relatively extended period of time. I mean, we're talking literally several years. And so that pressure has trained consumers to find a path to still feed and satisfy their family, but to do it in a more affordable way. And when you think about affordability, convenience, and joy of your family, and you put those together, really a spaghetti and pasta sauce dinner, you can't really do better than that. And I think with the combination of a more affordable, more mainstream brand in Prego, and then the addition of a really one-of-its-kind, unique, distinctive brand in Rayo's, it's really giving us a tremendous 1-2 punch in this very, very important area for consumers right now.
Every time you and I have talked, the one consistent thing has been the snacks business has gone well. That wasn't necessarily the case in this most recent quarter. What is happening there, and how concerned are you about snacks pulling off really, or just slowing down with some really strong growth rates?
Well, Brian, let's first put it into context, right? So as I've said many times, that through challenging economic environments, snacks historically has been among, if not the most resilient of categories in all of food. And I think it's been true in this journey we've been on as well. In fact, if you look at the last 3 years, the CAGR of growth for the snacks businesses have been 8%. I mean, that's higher, well above food, but also much higher even than historical run rates for snacking. I think what you did see in this quarter was a little bit of the normalization of that growth line and some building or mounting pressure as it relates to the economy in general. And so although we did see a more certainly off the pace quarter, I am not worried structurally at all about the business. In fact, when I look at the latest 4 weeks, so think of the period really through Memorial Day, which of course is a big weekend for snacking, the results have already begun to stabilize. And in many of the categories where we play, more of these elevated experience, think kettle potato chips over potato chips or organic tortilla chips, these categories, all of them moved back into positive territory and generally mid to high single digit growth rates. So although I do think we'll see a little bit of normalization on growth, I am not worried about the long-term trajectory and the belief that snacking will continue to be an outsized behavior for consumers.
Mark, in our world of finance, check out some of the stories that we're tracking here. So NVIDIA, they make computer chips, AI chips, $3 trillion market cap. The jobs report might be strong, another consecutive month of strong jobs growth. We're talking about AI and an Apple event. But you mean to tell me we are just at a place in this economy, and I think this is something going overlooked, that a bag of pretzels is a luxury?
Yeah, I mean, I wouldn't describe it as a luxury, but I would say that as consumers are navigating this backdrop and this environment of a lot of pressure, and remember, as much positive momentum as we see, and I want to be really clear, the path to consumer recovery in the world of food has never been clearer than it is right now. You see higher consumer confidence as pricing is normalized. You're seeing volumes begin to recover. One of the things I look at very closely is the number of categories in food where household penetration is growing. We're now up over 70% of the categories that are growing. So there's a lot of reasons to believe, but nonetheless, if you are a middle or lower income household right now, you're still dealing with high interest rates, higher rent. You probably just took a hit on car insurance, right?
God, I did. Mark, my car insurance is through the roof. It's like double digits. What the hell is going on here? Come on.
These are real world influences on consumer behavior. And so although I don't see it as a luxury, what you might see is a consumer being a little more thoughtful, a little more choiceful, and maybe willing to try a private label brand, or certainly to look for something that may be on promotion or deal. I think this will, again, when I think about snacking over a longer period of time, the resilience has been astounding. But I do think we're in a moment where you're seeing a little bit of that consumer behavior that we may have seen on meals and beverages categories 18 months ago. And that really is a little bit of the dynamic, and why perhaps for people trying to pinpoint this recovery in food, it doesn't move in a linear way, and that makes it a little bit tougher to predict.
Is inflation, do you still find inflation to be frustrating?
I do. I mean, I think we all wish that we had more of a catalyst of deflation to see more relief in pricing. And I think the reality is that as we look at the world today and look a little bit forward, we continue to see somewhat of a mixed bag. Now, certainly, that inflation level has come down dramatically. We're not dealing with what we were the last several years, and that is very, very encouraging. But I think this belief of costs or prices coming down in a material way is just not what we're seeing on the horizon. I think we're going to be in a period, as I've said before, Brian, where you're going to have some things that are deflationary, and you're going to have some things that are still ticking up. And the balance of that, I'm hopeful, is a more benign environment for inflation going forward, but certainly not deflationary in nature.
Mark, maybe you could put me on your car insurance. I'm thinking you pay a little bit of a lower rate than me.
I don't know, Brian. How old are your kids? Right? This is
it's a good thing I have no kids. Maybe we could pass as some former relative. I mean, we kind of look alike. I mean, I could see the resemblance. I mean, the beard,
I don't know. You have to tell me what your driving record is, Brian, before I do that. But,
it's stellar, just like the folks
But let's work together. I agree with you. Let's work together.
My record is stellar. All right, well, Mark Klaus, always nice to see you. Campbell Soup CEO, looking forward to that Investor Day coming up, right? And
yeah, absolutely. In September. We'll see you there.
All right, we'll be in touch. We'll talk to you soon.
Okay, great. Thanks, Brian.
All right, much more Yahoo Finance on the other side of the break.
Well, as NVIDIA continues to drive the market rally, companies are looking to hop on the AI train by reallocating capital to AI spend. Not all of it is created equal. Yahoo Finance spoke with Alex Karp, he is Palantir's CEO, about the challenges facing executives regarding AI expenditures. Here's what he had to say.
I think what everybody watching this is familiar with is you have a massive hype cycle around large language models, and then when you try to use them in your enterprise, you find out that it's more like self-flagellation and it's expensive with no output.
So how can investors evaluate AI expenditure and not go into the self-flagellation quote that Alex Karp just talked about? For more on this, we've got Luke Bars. He is Global Head of Client Portfolio Management for Fundamental Equity at Goldman Sachs Asset Management. Luke, great to have you on here. I know you just heard that soundbite, but from your perspective, what is the correct framework that investors should be utilizing to suss out AI CapEx and what is, really going to lead to growth on the R&D side versus just something buzzy to say on an earnings call?
Yeah, so firstly, Shauna, thank you so much for having me. I would say first and foremost, we need to reflect on the fact that AI is transformational. It is changing how we operate, and it is rapidly changing the dynamics in some of the technology hardware businesses that we assess and value as investors. Now, what I would say is just thinking through the timing and the sequencing of that, we're at a point now where your hyperscalers are investing every incremental dollar they can find in staying ahead of the pack as much as they possibly can on the LLM development side. And that means that if you're a semiconductor business that's aligned to server and hyperscaler capacity extension, you're in a very sweet spot at this point in time. Now, I think as we go forwards, we should expect competition. We should see some change in dynamic in that industry as we see more companies come to market with capabilities in that space, and or as we see the shift from the best-in-class, leading-edge nano capacity semiconductors towards something a little bit more cost-effective in the ASIC space, actually changing that a little bit. But right now, we're still very bullish on the space. We have to be thoughtful around valuations, but we see a lot of opportunity.
Luke, when it comes to, you were recently had the opportunity joining a small group of investors invited for the day to spend some time with Microsoft's senior management team. I'm curious what your takeaway from those conversations are just in terms of where we are in this AI cycle and how much opportunity it sounds like still lies ahead.
Yeah, and actually just interestingly, our leading investment team on the global and US side have just spent the week on the West Coast meeting with roughly 20 companies, both public, private, and actually also on the VC side. So I think we've got some real-time intel into what's happening in that space. And I think the very short answer is we're still at the very early stages of this transformation, especially in the public market context. We're still at the cutting edge of how can you utilize LLM and big data analytical tools in that AI framework, and then how can you apply that into real world solutions. And so I think at the moment, we're seeing a clear cycle of accelerated earnings in the enabling technologies. We're not seeing the evidence of that passing through into the software businesses in the way that we would expect to over the medium to long term. And so as we see the long-term adoption of AI techniques within those productivity enhancing solutions, I think that's a further bull case for some of those software businesses, especially the bigger names that we know are at the front edge of that development.
Yeah, earlier we were looking at a stat showing that over the last 11 weeks, 60% of the sell-off in tech stocks was coming specifically out of software stocks, Luke, which is no small amount. What is the framework for thinking about how to time a potential bottom for software stocks? Is there room for recovery in that area this year for investors?
Well, taking one step back, first and foremost, the way we're investing is bottom-up, long-term, fundamentally focused. And so I think it's always going to be challenging to say I can find the exact bottom in some of these names. What we need to do is differentiate between those that have leading capabilities, market-leading positioning, and are adopting these new Gen AI techniques into their solution to enhance the offering. And actually, if you can find those at a level today that looks compelling over a 5+ year basis, that's a very interesting entry point. So actually, if you look at the portfolios we're managing, we're adding exposure in some of those where we see the best-in-class software solution capabilities.
Luke, when it comes to some of the trends I saw, shifting gears here just a bit, because also one of your big takeaways, it looks like from this note from earnings season, was what we learned about the consumer. And to me, it was a bit of a mixed picture just in terms of, it almost seemed to vary company by company. I'm curious, what were some of the trends that you noticed here over the last several months?
Well, I think the simple conclusion is we're seeing bifurcation in the consumer. And it actually also parallels a little bit to that recent trend on the software side where we are seeing weakness in the lower end consumer. We are seeing that trade down effect. I think Mark Clues, you had on from Campbell Soup previously, very clearly articulated, you are seeing people think about value and how they're spending. And so as that cost of living issue has started to impact them more significantly, you are seeing that feed through into how they're trading in the consumer side of things. Now, the luxury space is still doing very, very well. And you're seeing significant momentum in some of that luxury part of the universe that actually doesn't look like it's cooling off too substantially. On the software side, I think the parallel there, just to come back to that for a second, is that is really weakness in the SME space. And so as we think about the forward look for markets and we think about the opportunity we have from this point forwards, the economy in the US looks okay. We've just seen latest payroll numbers. They look very compelling, but obviously it's just put the Fed on a little bit of a pause potentially. That to us is a very interesting entry point into a long-term growth story in the US because the economy still looks fairly robust as long as you can differentiate away from some of those businesses that are facing the pressures of that consumer spending challenge.
And taking a step back, and you mentioned kind of the macro impact of all of this, and you talk about the large number of rollbacks from a company like McDonald's. You're just talking about Campbell Soup, but you also talk about a company like Delta having the higher end revenue outpacing the main cabin. It makes me think about a K-shaped recovery, and I wonder to what extent we need to be worried about when that becomes the next shoe to drop for the economy, or as long as some spending is fueling growth, does it matter if it's a K-shaped recovery?
I think it's important in terms of thinking about how you're investing in the US equity market at this point, because there are going to be significant winners and losers. You're going to have businesses that are, for example, going back to our discussion around AI, at the right side of that AI investment cycle. And if we're seeing roughly $1 trillion of investment in CapEx in the S&P 500, and 800 billion of that is coming from your hyperscaler businesses, you need to be well aligned to that to succeed over the near term. But I think looking at it more medium to long term, we know the Fed has capacity to cut rates. I think you had my colleague Greg Torto on talking about small caps yesterday. We think there's a lot of opportunity in the small cap space. It's hard to say definitively when does that inflection point come, but the starting point valuation-wise is compelling. The economy looks okay, not perfect, but if the Fed has the ability to support that, should you see a worsening in economic profile, I think that's a very interesting place to be starting that investment cycle.
I want to end with this new DOJ probe into Microsoft and NVIDIA. Now, typically the Eurozone is ahead of US regulators when it comes to policy surrounding tech giants, social media, now looking into AI. How should investors be thinking about playing the regulatory moves coming from the US, and does it present more opportunity in the Eurozone?
I think first and foremost, we have to be very cautious as it relates to regulation just holistically whenever you've got dominance in individual industries. But at the same time, let's recognize that these are businesses that are driving an enhancement in the solution they're able to deliver, which is productivity enhancing and so deflationary in many ways. And so I think there will always be a weighting against, okay, the dominance of certain businesses with what it delivers to SMEs and what it delivers to individuals. I don't think there's necessarily strong differentiation between US and Europe. I think we have to be sensitive to that in both jurisdictions and actually just be very thoughtful in terms of the individual businesses you're buying and their exposure to those potential risks.
All right, Luke Bars, it was great to have you. We hope to have you back again soon. Goldman Sachs Asset Management, Global Head of Client Portfolio Management for Fundamental Equity. Thanks so much, Luke.
Thanks for having me.
All right, well, coming up next, we've got Wealth. It's dedicated to all of your personal finance needs. Brad Smith, he has you for the next hour. Stay tuned. We'll see you next week. Have a great weekend.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, the Bureau of Labor Statistics big jobs report just dropped this morning. We'll take you inside the latest data out of the labor market and explain what it means for your job hunt. Plus, mortgage rates towing that 7% line. We're bringing on an expert to help you with your home buying journey. Plus, how to find missing money that's owed to you. We explain how you could cash in on some missing, cash. The U.S. economy added more jobs than expected in the month of May. The labor market here adding 272,000 non-farm payroll jobs, specifically taking a look at the actuals versus the estimates. That is significantly higher than the 180,000 expected by economists. However, the unemployment rate rising to 4%, reaching that level for the first time since, get this, January 2022. For more on what this means for job seekers, let's get to Sanduina founder and CEO, Bridget Lorius, who joins us now for more. Bridget, just want to start off with your broad read on today's jobs report.
Yeah, Brad, it's great to see you. And absolutely what you all have been reporting all morning, right? It's been a big week, lots of reports, lots of data to sort of pore over. But it was a big surprise to see this explosive sort of growth in May when predictions were significantly lower. Healthcare, government, and leisure and hospitality, of course, leading those gains. Average hourly earnings higher, as you just pointed out. But here's the thing, Brad, these big headlines don't tell the whole story, right? The Bureau of Labor Statistics report is, of course, a tale of two surveys. They survey households and they survey employers. So, there's going to be discrepancies there. Unemployment, as you just said, hit 4% for the first time since January of 22. And importantly, the number of open jobs is the lowest, Brad, it's been in 3 years, and jobless claims are also climbing. And the number of available jobs per job seeker reached its lowest level since June of 2021. And here's what I would tell you, Brad, these numbers actually align much more closely with what we're seeing and hearing from our clients. It's tough out there.
Yeah, absolutely. You mentioned this a moment ago, a tale of two surveys, and that was much of the reaction that I was seeing by some economists on the interwebs after the report dropped and after I had a moment to kind of catch a breather, step off set for a second, and then come back here to start our wealth show. And many of them pointing to that household survey. What jumped out there that people need to kind of be reminded of here as we're really evaluating, sure, the headline beat, but then there's still some murkiness under the water there.
Yeah, it's so many things to kind of dig through, right? But clearly what households are reporting is a lot of people lost their jobs, right? And businesses, of course, are reporting that they're holding, they're planning to continue hiring, but they're even acknowledging that they're planning to hire at a slower rate. Look, I'm not an economist. My job is to help people find joy and find jobs, but it's clear that there's a gap between what employers are reporting and what households are reporting. So it will be interesting to see how revisions come out in next month's report.
Yeah, and it seemed like from what I was seeing, the difference in those was what we were seeing on both full-time employment versus that part-time employment print and where that came into play on the tail of the two surveys as we were breaking down there. So let's hold up, wait a minute, can we put some joy in it? Because people want to know, as they're perhaps out there throwing their hat into the ring for the positions that are open, what they should be remembering as they're on the job hunt right now, Bridget.
Absolutely. And I think, Brad, what we're seeing and doing with our clients is really trying to modernize our approach to the job search, right? It's no longer spray and pray, as people say, just pummeling out your resume to as many online job postings as you can. That is an ineffective strategy. And in fact, what we're hearing from recruiters is they're done with that approach. A lot of recruiters are saying they're not even posting jobs online anymore because it's just become too overwhelming. So job seekers really have an opportunity here to get savvy and strategic about how they're approaching their job search. So we, Brad, have sort of a three-pronged approach, and it's really about managing your mindset, building your brand and plotting your plan. So managing your mindset, this is really all about getting in touch with yourself, getting real about the market so that you can manage your own mindset and get resilient and tap into the grit that you have and that you're going to need to get through the process, because it is tough out there. So this includes things like getting a team around you of people who are going to be cheering you on and supporting you through the journey. It's also about cataloging your many incredible strengths so that you can boost your confidence as you move through this process. So that's kind of what we cover in managing your mindset. Secondly, it's all about building your brand. And that's everything from, of course, building a show-stopping resume and cover letters and building your brand positioning statement. But this is really, Brad, all about that LinkedIn profile. I just recently read the craziest statistic that hiring managers spend 25 times longer on your LinkedIn profile than your resume. And I can tell you, testimony here, 3 clients in the last week have told me that hiring managers that they've interviewed with have said, don't even bother sending me your resume. I'm going to look at your LinkedIn profile. So that profile is absolutely critical, tip to tail. The banner photo behind you, don't put your dog on there unless you work for a pet care company. Every centimeter of that real estate is so valuable. So you want to spend the time on it it deserves and get those recommendations up there. Put the featured section, make the featured section really shine and sing. That's where you have an opportunity to showcase your skills, your strengths, and how people think of you. And then finally, I would say it's all about getting that plan together, which is, of course, identifying the companies and the leaders that you're interested in. But this is all about next-gen networking, Brad. And I know you've had some guests on recently talking about what modern networking looks like.
Yeah, that's absolutely right, and how important that is for potentially getting into that new position. Just lastly, while we have you, only got about 45 seconds left. When it comes time to negotiate a salary, especially in this labor market right now, what are some of the most effective strategies you're seeing being enacted?
Yeah, so the great news is that a lot of states are now requiring pay transparency. So with very little effort, we can do some research online to see what are sort of standard ranges for positions. And then I would encourage people to talk about it. That's what we say and coach our clients to do. Have the conversations with peers, have the conversations with people you don't even know, because with visibility and transparency comes power and knowledge.
Senduina founder and CEO Bridget Lorius. Bridget, great to see you. Thanks so much for joining us this morning.
Thanks, Brad. It's great to see you.
Likewise. Saving for retirement can be a daunting task for workers, even more so for contractors or freelancers who are vulnerable to the EBB and flow, well, the ebb and flow of their income streams. For more on how this sector of the workforce can tackle retirement, let's get to Yahoo Finance's Carrie Hannon. Carrie, clearly I've been studying too many tickers this morning. Everything that's 3 or 4 letters is just a ticker to me. But the ebb and flow here, break this down for us.
Brad, it is really a big deal because there's something like more than 1 in 10 U.S. workers is a contractor or independent worker. And what that means is you don't have access to an employer-provided retirement plan. And you may think, oh, well, that's fine. But the fact is that the statistics show that just a very small percentage of people, like 5%, start saving for retirement if they're not automatically enrolled in the retirement account at their employer. And when they are automatically enrolled in that plan at their employer, it bumps up to like 90%. So you have to do it yourself. And it's super hard because a lot of people, especially if you're just getting out of school and you're starting your first job, you go, oh my gosh, I can't possibly squeak by and save for retirement. I can't afford it right now. So you kick it down the road. And that is something that you can't afford to do. So it's pretty simple. There are just a couple of easy ways that self-employed people can set up their own retirement account. And it starts with the the individual retirement account, IRAs. So you've got the traditional IRA, and you've got something called a SEP IRA, S-E-P IRA, which is just a simplified plan that allows you to put aside more than the traditional IRA does. And both of those come in a Roth format. So that means the first two, the traditional ones, you don't pay the taxes going in, but you pay the taxes when you take the money out at retirement. With the Roth, as the listeners probably all know, you pay the taxes going in, but not when it comes out at the end, which is really sweet as well. Then there is something called the solo 401k. So you can set up a 401k just for yourself if you're a solo employer and you are the sole employee. And that lets you set aside even more. So those are the three big ways that you're allowed, that you can simply do this. The final one I like is a health savings account. So most freelancers are enrolled in pretty high deductible plans. If you're in one of those plans, you can open a health savings account. And with that account, it's like a triple whammy because, or in a good way, you don't pay tax going in, you don't pay taxes on how that grows and accumulates over the time it's in the account, nor do you pay taxes coming out if it's used for health benefits. So I think there are more nuances. All of these have income limits, all that. Check out with the IRS. But it's really great. The final thing I'm going to say is states are now getting into the game. Several states are now offering individual retirement account programs for self-employed workers. Oregon is one of the first ones out of the gate doing that, but Virginia does it, California. So really take a look and see if your state has that.
Now, Carrie, what can younger workers in this situation do to push back on the feeling that retirement is so far away that getting started can take a while?
Yeah. Oh, that's such a good question, Brad, because I don't know about you, but for me, it was like, are you kidding me? Retirement? I mean, that was like so far in the distance, I couldn't even imagine it. But I suggest that you do this little mindset switch. You think of it, replace the word retirement with life. So you are saving for life. You are saving for all those great, rich life experience you want to have. And if you refocus it, then it seems to have a little more meaning and it makes it a little bit easier to get started. And the other final thing I would say, Brad, is put this on cruise control. This is so critical. If you work for yourself, automate, automate, automate. If you can just from every paycheck you get, because it can be erratic, it can be up and down, as we mentioned at the top. If you do a set amount from each paycheck going directly into that individual retirement account or whichever one you set up at the mutual fund company or your credit union or your bank, wherever you set that up, if you automate that, so every month or twice a month, a certain amount goes in there, even if it's a tiny amount at first, it really gets the discipline and allows it to accumulate. And trust me, you honestly don't miss it if you just do it automatically.
Yahoo Finance's own Carrie Hannon. Carrie, I feel a day closer to retirement than I did yesterday. Appreciate it.
Thanks, Brad.
Let's switch gears here and talk a little NVIDIA. NVIDIA set to complete its highly anticipated 10-for-1 stock split after the market closed today. This strategic move aiming to make the stock ownership of the chip giant more accessible, but with greater accessibility to investing in NVIDIA, what should investors consider on the next chapter for the AI darling? Adam Coons, Winthrop Capital Chief Investment Officer, joins us now to discuss. Adam, great to have you here. So, I mean, this is the big day after the market closed, and then Monday we'll see the prices reflect the 10-for-1 split. This is not the first time we've seen a split for NVIDIA, nor a Mag 7 company over the past year. So, all of these things considered, what makes this one different?
Yeah, first, thanks for having me. There's probably going to be a handful of people that opened their account on Monday and didn't see this coming and wonder what happened. But for those paying attention, I think one of the big things that you see generally with a stock split, and it's to be expected with a stock that's hit 3 trillion market cap, is that it does let more investors into the stock, and that can sound like a good thing. And generally speaking, it is great to open up, the ability for more people to invest in a great company like NVIDIA. The downside of it is that large share prices usually are positioned for institutional investors who tend to be more long-term, and their decision-making is long-term. And so they're not as visceral in their reactions to maybe an earnings release or some other news event that would cause them to, sell out of an entire position, relative to retail investors who would buy in, and they might have a more emotional attachment to the stock, both buying and selling. So that can lead to heightened volatility as you start to dilute the institutional buyers, introduce more retail investors that, like I said, can be a little bit more quick and emotional with their buying and selling decisions of a stock like this.
NVIDIA has been the poster child for much of the AI-fueled gains that we've seen over the course of the last year and change. And so many people are trying to figure out as well, does it make sense if they're not invested right now to potentially add to the portfolio come this stock split as it looks to be more affordable, at least on price value?
Right. Yeah. I mean, obviously the whole AI trade has gotten a lot of traction. And if you have been out of it, it's probably difficult to watch these stocks that have doubled, tripled, quadrupled. So it probably will open up investors who have sat on the sidelines. Now, keep in mind, any investor who has, a holding in the S&P 500 through an ETF or something like that, they do still own a piece of it. So I hope investors kind of keep that in mind when they're trying to decide whether they want to, buy this individual stock. But I think, one thing to look at is this is a stock that has already priced in a lot of that upside. And so what we're trying to do is find the other areas to play machine learning, artificial intelligence in a way that can complement what NVIDIA is providing with their chipset, because, right now that is a one-trick pony. They're GPUs that help with the whole, AI processing, but there are a lot of other companies that are using machine learning to enhance their current business model. And that's where we're starting to focus as we start to, sell our positions in NVIDIA, because we have cut, as we've seen the stock go up and up and up. We're prudent in taking gains. And right now we've just about halved our position in NVIDIA.
That's interesting, Adam. And so now, as you're looking at what we could maybe summarize as an AI-fueled broadening, then some of the other companies that can either be beneficiaries or, as we've heard from some of our prior guests, looking at things like utilities that are going to have to power data centers, all the things that are kind of interconnected into where this demand is really pushing the broader market as well. What are some of the plays that you're considering?
Yeah, so it's important to understand that obviously the whole AI pie is growing, and it's not totally certain how big it is right now and how big it can get. But we do know that it is going to be a large market. I think no matter what, there's a lot of unknowns in AI, but the one known is that it is real and it is going to be a very, very large market. So we're looking at other ways to play it, like you said. One way is obviously with, introducing increased complexity in technology and how we use technology, that also increases the risk from cyber attacks. And so I think that if you're looking for themes within AI, you can't ignore cybersecurity as a whole. And there are a few different ways to play it, but right now I'm really liking CrowdStrike. They are one of the leaders within the space and using machine learning to have a more advanced version of cybersecurity. The valuation is a bit rich, so be careful there. But I still like the stock. I like the trajectory. I like the business momentum, not just the stock momentum, because they do have a wide moat. Their acquisition cost for customers is the lowest in the space. So that's one of the reasons I like CrowdStrike. Additionally, you've seen Qualcomm has come out with some new chipsets that kind of complement artificial intelligence, and this is in laptops and other devices that can help with, you just said, the power consumption of them. And so I think that's a big piece. It's looking at all the different ways to slice this up, and you can find winners not just in one stock, because that's really the way to be careful here, is to diversify away from the concentration. We know AI is going to continue to grow, but staying in one company can create some difficulties. So spreading those bets out, and like I said, Qualcomm, CrowdStrike, and then we also like Alphabet. That's a more vanilla name, but obviously a big player in the AI space.
Yeah, Adam, we only got about 30 seconds left here. Should investors be concerned about the short bets that are growing against NVIDIA right now? About $34 billion, according to S3 Partners. I mean, you think about how that compares to the $19 billion against Apple, $18 billion against Tesla. You can essentially combine those two and still be in the ballpark of the short positions that have mounted with NVIDIA. What do you make of that?
Absolutely. And it's just like the stock split is something like that can add to the volatility. It can actually add to the upside. If there's a short squeeze, you could see a large pop in the stock, but also it does increase the risk to the downside. So I think it's just something to be careful of, something to be aware of in your position sizing. Remember that this is a high volatility stock. It's been going up and up and up, and the volatility's been the upside, but that same thing can happen to the downside. So just make sure you protect yourself with managing your position sizing.
Adam Coons, who's the Winthrop Capital Chief Investment Officer. Adam, great to see you. Thanks so much for joining the show with us today.
Thank you.
Certainly. The May jobs report coming in hotter than expected, but what does this mean for your portfolio? We'll speak with an expert next. The U.S. economy added more jobs than expected during the month of May. The report telling the opposite story from data out this week that suggested the economy is slowing, which was fueling hopes of a rate cut. To break down what to expect from equities amid a murky macro backdrop, we've got Neil Mukherjee, who is the TIAA Wealth Management Division Chief Investment Officer. Neil, great to see you. Great to have you back in studio with us. Always a pleasure. So first and foremost here, I mean, we were speaking about this report earlier, actually, and one of our guests calling it a tale of two surveys here. I mean, what's your read in on the data that we got here this morning?
Yeah, well, this is a trend that's been going on for some time now, right? Where the household survey has kept showing that the economy is losing jobs, there's no traction. It measures jobs slightly different than the payroll side of the equation does. Payrolls tends to count your jobs who have people who have multiple jobs, for example. So it potentially overstates the number of jobs. The household does not take into account the immigration aspect of it. The truth of the matter is we're somewhere in the middle, and we'll know that in a few years when everything is reconciled. So a couple of things with respect to this jobs number. A, the economy is not falling off bed. It's still resilient despite the fact that we've had a couple of years of massive interest rate increases. But there is some slowdown in terms of the unemployment rate ticking higher. When I look at the totality of the labor market data, less people are quitting their jobs, so that means less wage pressure. And the number we got earlier in this week, where we saw 8 million job openings, which is down about 18% year over year. Obviously, the peak was 12 million a few years ago, but in totality, I think it paints a picture where the market is cooling, the labor market is softening on the margins, but the economy overall is still pretty resilient.
I mean, if you could speak that well from an economist perspective, I am amazed at how much you can speak on the chief investment officer perspective as well here, too. Give us the playbook then. If that's the read-in on where the economy sits right now, is there any massive portfolio shift that you envision investors need to at least consider right now?
I don't think so. And if you look at the action in the markets today, again, the story is very much the same. The bond market is still not entirely comfortable and sure that the inflation beast has been slain, which makes sense. The equity market, despite the fact that interest rates are higher, it's trading higher today. It was a surprise on the upside, and it tells you that the Fed may have to keep interest rates a little bit higher for longer than most people were expecting, but the equity markets are higher. The story there is AI and corporate earnings, as you were discussing with your previous guests. So the data is going to become much murkier. The outlook is going to become foggier as we go through the rest of the year. What investors need to do is be very disciplined. They need to be diversified across different asset classes. Most importantly, they need to have their financial plans in place and stick to it.
You know, it's interesting. What type of rewarding do you expect the market to give companies in this environment that once we start to get earnings that roll in for Q2 that either start to beat or miss? Because in Q1, it seemed like they were getting rewarded less and they were getting punished more than historical averages, at least the 5-year historical average based on, I think, some data from FactSet.
It's a really interesting question, and that happens when valuations are extended.
Okay.
Right? The good news has been priced in, so the bar for surprising the market on the upside and getting rewarded for it is that much higher. So we're there. We were there in Q1. Obviously, the markets are at all-time highs. I think what's interesting in the earnings story is a couple of things. First of all, we were in an earnings recession. Now we've had 3 quarters of an earnings recovery. That's because the economy is in decent shape. Inflation is coming down, but it's not crashing, which adds to the pricing power of companies. So that's a good thing. The other is that if we do get to like $240 a share that the market is expecting this year, and as we come to the end of this year, and the market thinks that we can achieve that $270 a share, the market could trade higher. The final thing I'll say on earnings is we're seeing this rotation away from the mega cap earnings to the other companies' earnings accelerating. The mega cap earnings are expected to decelerate as the year goes through. Other 493 companies' earnings are expected to accelerate. That'll create some volatility, some uncertainty, but if we are in this environment where growth is 1.5%, 2%, inflation is sticky but coming down slowly, and the expectation that the Fed is still inclined to cut interest rates is there, the market can slowly grind higher.
I'll tell you the question that everybody wants an answer to as they're going into their weekend, perhaps going to fire up the grill or go for a swim, is whether or not the S&P 500 is going to continue to see new all-time highs, especially as we have today, at least on the intraday basis, if we have a higher for longer tenor continue to remain in place after next week's Fed meeting.
I think it can, and it can because of the corporate earnings story, which is good. You need this economy not to overheat. And that's why I come back to those numbers, which is 1.5% to 2% growth, 3% like inflation, but slowly gliding to that 2.5% number. The Fed is still basically dovish, even though next week's meeting they will have to sound a little bit hawkish. They may go from 3 rate cuts indicated to about 2 rate cuts. We'll see what happens. But basically, if they are still inclined to cut rates, and they can do so before the economy really gets into trouble, then I think this equity market can go to new highs. Now, what I will say is, from an asset allocator's perspective, and as you know that we keep our clients invested in our asset allocations which make the most sense for them, equities are going to be in a bit of a consolidation zone, at least till that earnings can play catch up with earnings, with valuations, and the disinflation narrative comes back into the marketplace. That is going to be a necessary condition, those two, for equity markets to move higher. Final thing, fixed income is again looking attractive with yields where they are. So you construct a fixed income portfolio which has govies and corporate bonds, high yields, some riskier aspects of the fixed income market, you can get 5.5% to 6% yields, and they're good diversifiers at these levels, because if you do have a situation where the economy weakens more than expected, the Fed has to cut interest rates, then yields will come down and provide that ballast against the equity risk that I talked about.
All right, haven't heard govies in a while, so we're going to fire up the Yahoo Finance t-shirt maker and throw that on one of those. Neil, great to see you.
Good to see you.
As always, Neil Mukherjee, who is the TIAA Wealth Management Chief Investment Officer, joining us here in studio. Well, switching gears, everyone, 1 in 7 people have unclaimed property. And that's more than $20 billion worth of money and assets just sitting around, according to the National Association of Unclaimed Property Administrators. Here to break down how you can find and claim what's yours, we've got Yahoo Finance's very own Molly Moorhead. Molly, you got to take us into this one and how we find out what's unclaimed and if I'm owed something.
Free money, right?
Yeah.
all day long. So there are a variety of accounts that can commonly end up in unclaimed property, and it's things like unclaimed pensions from an old job or a 401k from an old job, life insurance policies, back pay, again, from previous jobs, and then savings bonds. You think about things that started out on paper and are now electronic. Any of that can get lost, but it's still yours and you should claim it.
So where should people look?
Yeah, well, I've got several websites to tell you. The Pension Benefit Guaranty Corporation, that's the federal agency that oversees private pensions, lets you look for any pension in your name with your name and last 4 digits of your social security number. Life insurance policies, you can look, if you're a veteran, look on the VA website, and otherwise the National Association of Insurance Commissioners has a locator tool. Labor Department is where you go for unpaid wages. Treasury Direct, that's where you find savings bonds. And then the best one, probably the best place to start really, is missingmoney.com. And this is going to capture everything that, aside from what I just mentioned, and it will find unclaimed accounts in your state. So you would put your name in and your state, and it will find anything that's gone to unclaimed property in your state. And I want to underscore, it's free to search all these websites.
Wait, so how exactly does this all happen?
It's weird to think that we could all just have money out there, right, that we don't know about. But I think of it as like with life events. So if you move to a different state, if you change jobs, anything like that where you might move to a new account and forget about the old one. So it's more common than you think, and it's very easy to search, and it's worth it.
Okay, so it seems like there's no harm in looking, but am I really likely to strike gold here? How many people are chiming off on social media saying, oh my gosh, you won't believe the windfall that just came my way?
Okay, well, I can tell you from personal experience that I search on my state's site, from time to time for myself and my family members, my husband, my parents, and I just found $25 in my mother's name from the state toll agency. So, these accounts that you can create to automatically pay highway tolls. There was an overpayment, and so there's $25 in her name. I recently heard from a colleague that her husband had been gifted stock in an old employer, never claimed it, $16,000. So I would call that striking gold.
Our studio manager, Mike, in here, his eyes just popped out of his head. Okay, Molly, thanks so much. We got some Googling to do after we end this segment. Thanks so much.
Bye, Brad.
Appreciate it. And coming up, private credit has been attracting billions of dollars over the past few years, but could the boom be nearing an end? We'll discuss that next. There's a relatively new asset class that's been attracting billions of dollars over the past few years: private credit. It grew to over $2 trillion in assets and committed capital last year, according to the International Monetary Fund, known in your hood as the IMF. But as of lately, some investors are becoming increasingly concerned that the boom for the asset class might be over. To break down private credit and its risks, we've got Yahoo Finance's very own Julie Hyman here. Hey, Julie.
Hey, Brad. I've been seeing a lot of headlines about private credit recently, and so that led me to dig into it a little bit and got some data from the IMF. Indeed, we have seen a big growth and big returns for investors from this asset class. It isn't brand new, but really over the past several years, it's attracted a lot more attention and a lot more money. So this from the IMF shows us the returns that we have seen in private assets versus public assets. So private equity is here in purple, and this doesn't show the absolute amount, it shows gains. Private credit here in blue, it gained about 12% last year. And then you've got the S&P 500 in yellow and MSCI, the world stock index, in red here. So you've really seen the returns from some of these private markets really do well and attract a lot of money here. Just a couple of examples that we've heard about as of late. Just today, we learned that Bain Capital would be buying Power School for $5.6 billion. And private credit is part of that deal that is financing it. There was just a report that Goldman Sachs had put together a $20 billion fund to invest in private credit as well. All of this adding up to that $2.1 trillion that the IMF saw last year, which one would imagine is going to grow this year. An Apollo executive at a conference recently said that this thing could even climb to as high as $20 trillion. Now, it's still a small part of the overall market, especially in fixed income, but it is indeed growing. So what the heck is private credit anyway? It's kind of the credit counterpart to private equity. So basically, it's investment funds lending to corporate borrowers. So what does that mean? It means like you've got a Blackstone, a BlackRock, an Apollo, the parent company of Yahoo, raising funds from investors, just like they would raise a private equity fund. In the case of a private equity fund, they then use that to invest in companies, whether public or private, buy pieces of those companies or buy companies outright. In the case of private equity or private credit, they are lending that money out. Some of it is direct lending to those companies. Some of it is other types of financing instruments. Some of it has to do with lending for real estate, for example. But it's just the lending side of the equation instead of the buying the piece of the company side of the equation. There are lots of publicly traded credit instruments as well, like corporate bonds, for example. This would be the private side of that. So, Brad, it's an interesting area, and it's one a lot of folks are talking about. There was just a conference called Super Return International that happened in Berlin, and there was some talk there about whether sort of interest in this area might have peaked, but it does seem like it's still growing.
Yeah. So, as with anything, there are risks. What are the risks of this?
Yeah, there have been some sort of flags to some of these risks, both discussions at these conferences. The IMF in that same report flagged some of the potential risks. Valuations infrequent. You know, in a publicly traded market, it's liquid, it is more transparent, you know what's happening, and you mark your assets to market. In other words, you periodically have to look at the overall public market and then value your assets accordingly. That doesn't really happen as much in private credit or any private markets for that matter. Credit quality is not clear or is easily accessible. This is kind of linked to that. If I am direct lending to a company and that's a private transaction between me and the borrower, then that is not publicly available information. And so it's unclear to analysts, for example, what the quality of that credit is. How likely is that borrower to default, for example? And then finally, it's hard to understand the systemic risks. You know, we talk about systemic risks sort of dating really from the financial crisis. That's when there was most of the discussion around systemic risks, because risks from subprime mortgages were indeed systemic. We don't know. The size of this seems to indicate that it's not systemic, but it is something that people who analyze financial institutions and the system are paying more attention to.
Julie, thanks so much. All things private credit. All right, appreciate the breakdown. Coming up, everyone, mortgage rates continue to hover around that 7% mark. We're speaking with an expert to help you with your home buying journey next. The average rate on a 30-year fixed mortgage fell to 6.99% this week as it continues to hover around that 7% mark. For what the latest numbers could mean for the housing market, let's bring in Yahoo Finance's own Rebecca Chen for a further breakdown here. Hey, Rebecca.
Hey, Brad. So we have been seeing mortgage rate dropping or hovering around that 6% mark for a while now. And as you mentioned, this week rates fall below that to 6.99%. And what this is doing to the housing market is pretty clear. There has been sign that it is pressuring the housing market. Simply put, data is showing us that rate is still too high for many home buyers given today's housing prices. Earlier this week, we saw another report on mortgage volume showing that purchasing application declined 4% and refinancing dropped 7%. And this is quite interesting because home buyers are retreating at a time that is the spring buying season. And typically, this is supposed to be the busiest buying season in the whole year, but instead we are seeing that drop in purchasing volume. And I think all of this has really to do with affordability. We have seen from another report that just last month, the average mortgage payment has increased by $60 for on an average monthly mortgage. And this is, while $60 doesn't sound like a lot, you have to think that this is nationwide and average, so many times people could be paying a lot more and sometimes a little bit less. And annually, another report is showing us that all four regions to the U.S. has seen affordability decline over the last 12 months. And you know, as we've been talking about it a lot on the show, people are really paying more out of pocket for that borrowing cost now that rates are hovering around 7% mark.
All right, Rebecca, thanks for teeing this up for us. For much more on the housing market and what mortgage experts are telling potential buyers, we're joined by Melissa Cohn, who is the William Ravis Mortgage Regional Vice President. Great to have you here with us today, Melissa. First,
thanks so much.
Yes, absolutely. So you just heard the breakdown of where we're hovering right now, still around that 7% marker. Does the buyer sentiment change at all at this level? And if so, where could we see some potential bids be thrown into the ring?
I mean, psychologically, I think people want to see rates well below 7%. You know, real estate values have remained quite high, even though they've dropped a little bit recently. That, you know, as you said, the affordability factor becomes an issue. I think that when interest rates drop below 7, if we get them down to 6 3/4, 6 5/8, maybe 6.5%, that we'll see, you know, renewed interest in the home buyers coming into the marketplace. And the other thing that we have to take into consideration is, when is the Fed going to start cutting rates? You know, it's the spring selling season. Do people want to buy now, know that they're taking a higher interest rate, but having the ability to refinance at some point, hopefully in the next 12 to 24 months, in order to be able to reduce their monthly payment? Because it really is all about the monthly payment and not about the print rate.
Now, yesterday, we had Doug Duncan, who's Freddie Mac's chief economist here. I asked him his thoughts on buying now versus waiting for rates to decline. I would love to hear your reaction to what he said on the other side. Let's take a listen.
So if at today's price and the amount of money that you'd have to borrow, the payment fits in your budget that you have, then you buy today, you're a homeowner. If you're speculating on whether interest rates are going to fall, whether prices are going to fall.
And now banking on refinancing.
Yeah, but then you've moved into the realm of being a speculator.
Right.
Some people can afford that. A lot of entry-level buyers can't really afford that.
And Melissa, I want to get your reaction to that as well here, especially as there could be those who are tempted to speculate right now.
I think that really it's all about, you know, affordability and whether or not you need to buy a home. I mean, you know, the American dream is that everyone becomes a homeowner. And it is, I believe, quite likely that when interest rates come down, that more buyers will come into the marketplace and real estate prices will move upward. So to be able to buy today, and if you can afford to buy today and become a homeowner, you know, obviously we all hope that interest rates will come down, but I don't really think that makes you a speculator in the market.
For a lot of new home buyers out there, what are the things that they need to remember, especially if going into a market like this and trying to figure out where they're going to get the best bang for their buck long term?
Well, I think that they have to look at themselves financially first. Where do they stand in terms of their career, in terms of income? is their income stable? If they can afford to qualify for a mortgage today and they know that their income is growing, even if rates were not to go down, then as their income grows, that the affordability factor for them will improve. It's also a question of, are you buying something just to get into it today? Like, people shouldn't settle on something that's less expensive in order just to have a lower monthly payment if you're buying something that you're not going to see yourself in for a very long period of time, because there are transaction costs. You have to pay broker's commissions, there are closing costs, transfer taxes that you have to pay. So you have to make sure that the decision to buy today is a prudent one and one that will withstand, the next 2 or 3 years. So to make sure that you haven't really thrown money out the window.
Are some of those costs making new homes more appealing for new home buyers?
Well, I mean, if someone's purchasing a new home, there are builders who will actually give people discounts on their closing costs and discounts on rates, which is obviously an advantage. Closing costs vary by state to state. There are certain states where closing costs are a lot less expensive and other states where it's a lot more expensive. So you have to take not only the purchase price and the mortgage, but all of your closing costs into consideration. Banks will want to see that you have enough money for your down payment, that you have enough money for closing costs, and that you have some money in reserve. Banks today have become prudent. Banks are not throwing out no income verification loans and telling people, oh, you should just buy now and worry about it later. Banks are really trying to make sure that every mortgage they make is one for the buyer that's going to be able to make their monthly payments.
Certainly. Melissa Cohen, who is the William Ravis Mortgage Regional Vice President, thanks so much for taking the time here with us today.
My pleasure.
Coming up, everyone, if you're traveling this summer, we've got some safety tips for you to protect your money and have a stress-free vacation. You're watching Yahoo Finance. Planning on traveling this summer? If you are, you're probably using some online resources for booking, whether that's for your plane or your hotel, or even activities and guided tours. We like those. But are you doing all you can to keep yourself and your money safe when you book? A recent survey from McAfee Labs shows that 34% of Americans say their trust in online booking has decreased, mainly due to AI and deepfakes. So here to give us some tips on how to have a fun summer travel season while also staying vigilant, we've got Abhishek Karnik, who is the McAfee head of threat research. Abhishek, great to have you here with us today. Okay, what are some of the common pitfalls that you see as people are really just trying to get some relaxation in and plan for summer travel, but then are also not aware of some of the vulnerabilities?
Yeah, absolutely. As people gear up for travel this year, we're seeing 1 in 4 Americans falling victim to scams and probably more than 25 losing $1,000 or more. So what we need to be careful about when we're booking is online is to be cautious about those too good to be true offers, which get pushed at you. Either they come through text messaging or through emails. The other thing that you might want to look for is impersonation websites. So when you're booking online, you want to make sure that you validate the website that you're booking through. There's a lot of impersonated websites, booking.coms, which are faked out, photographs that might be incorrect or AI generated, for example. So you have to be cautious, really be skeptical about what you are booking when you're booking, being cautious about what you're looking at.
Okay, and so with that in mind, how are we potentially doing on this kind of year over year? Have the threats increased, and ultimately, where are people taking the correct safeguards?
Yeah. So threats will follow the people, right? I think people are getting ready for travel season, and therefore you can see an evolution of threats in that space. To assist the threats, you have a lot of tools nowadays, like the malware guys, the bad guys are leveraging AI and trying to utilize that to create automated text messages or even automated emails. In the more extreme cases, probably not related to travel, sometimes you're seeing deep fakes, things like that. So those are essentially what you want to be looking out for. Have a heightened level of skepticism. When you're traveling, you want to look at there are two pieces to it, right? It's before you travel, when you do the booking, that's where you need to be cautious. Which websites are you visiting? Can you trust the website? And be cautious of phishing scams. So don't give away your information to people that you don't trust.
What about?
And then you have the situation where you're traveling,
right,
where you might have impersonators, somebody faking to be a travel agent, things like that, or you scanning an incorrect QR code, which leads you to an incorrect website, which scams you essentially.
What about when you're midway and in your travels? You think you're just bopping around, enjoying vacation, and you might actually be a target. How do you kind of spot the signs when you're along the way, especially if you're in a foreign country and you might not be privy in entirety to the local language?
And that's exactly what the scammers are looking for. When you're a little lost, they might pose a good, they might give you an incredible deal on a travel, or you might show up to a website and realize, or show up to a hotel and realize that, well, the hotel doesn't exist or the Airbnb doesn't exist. So you might want to use, a lot has to do with being cautious, being skeptical. Don't pay money upfront. Try to see if you can use credit cards to make payments. If you see people asking you for gift cards or asking you for cryptocurrency payments, those are huge red flags to start off with. So having that heightened level of skepticism, not believing, who's interacting with you, don't take their word for it, is extremely important. And having the right tools in place as well. Make sure you're using trusted websites, trusted applications on your phone, and using VPN, for example, when you're hopping onto free Wi-Fi is equally important, because these are the different sort of vantage points that scammers are utilizing to take your money away.
Great reminders there. Abhishek Karnik, who is the McAfee head of threat research. Great to see you. Thanks so much for taking the time.
Thanks, Pat. Appreciate it.
Hey everyone, that's it for Wealth this week and for today. I'm Brad Smith. Thank you so much for watching. Guess what though? We've got more Yahoo Finance coming your way to round out what's been a record-setting week for some of the major averages here, as we've got a fresh new intraday high an all-time high for the S&P 500. Don't go anywhere. Market Domination with Julie Hyman and Josh Lipton. They'll count you down to the market close that starts at 3 p.m. Eastern Time. You don't want to miss it.